What's up, guys? Sam here, kicking off the True Momentum class for Saturday, May 16th, 2026. Good to see you guys. It's not that common we hang out on Saturday. I hope you're comfortable wherever you are in the world. It is a beautiful day here in Austin, Texas. There's not a cloud in the sky. The squirrels are plentiful. I recently gave them more Cheerios. They ate all their peanut butter. I don't know how they eat it so fast. Yeah, no more tater tots. Yeah, they finished the tater tots actually. What's funny is if the food that I give them is big enough for them to carry, they'll take a little bit with them. All right, guys. Well, we're all here. We're all here. We're all excited. We're all locked in. We got quite an afternoon ahead of us. I hope all of you have had a chance to install the indicators, play around with them a little bit. I'm a big advocate of swinging the golf club. You know, today I'm going to give you the book on how to play golf, but at the end of the day, you can read the book, you can memorize the book, but at some point you got to swing the club. So I'm very excited here, guys. This is 9 years of work. I told you that I set the bar low. I think on this one, I told you to expect the Thriller album, and I love the pressure. So I look forward to having some fun with you and really deep diving these indicators that are the reason that we're all gathered here. So, without further ado, thank you again, all of you, for being here. I saw that the Daryl Strawberry is in the house. Former outfielder for the Mets. Thanks for being here, guys. Let's dive in. So, thanks for attending today's class. We're going to cover lots of topics today. Everything is being recorded. This class is being recorded. The install session was recorded. The live trading will be recorded. Everything's recorded, so no worries. If if something happens, you miss something, the recording will be available to you by the end of the day. Feel free to just go back and check that out. Here's one thing that I will rely on you guys to do is remind me if we need breaks. The last class that I did, I think, was almost 5 hours. I go at my own speed, and my own speed is no breaks. No breaks on the train, but there's a lot of us here, so just remind me, and I'll take some breaks. For those of you that are watching the recording, you can always change the speed if you'd like, so just a heads up on that. And that's how you do it, is down there. So today's class is scheduled for 4 to 5 hours. I do have a tendency to be a little bit overly explanatory with things, so book the next 4 at least, but maybe 5. We do have a lot to cover, and I'm going to try my best to respect everyone's schedules. And the recording again will be available to you in the class folder. So, quick reminder, my name's Sam Shames, VP of Options here at Simpler Trading. Been here with Simpler Trading for 9 years, 8.9 exactly. In about 2 weeks, it'll be 9 years. So I've been here a long time. I'm very thankful for John to build what he built. I refer to this place as the Library of Alexandria, and so that there's just so much information here. And the library, the books of this library, are really the traders. Right? You have a diverse set of traders here with lots of years of experience, and everyone with a specialty in something different. So the cool thing is, if you can kind of step back and see the forest, you then are able to say, okay, well, I'm going to learn this from this person, that from that person, This is the best thing that this person does. I'm going to take all of the best things they do and just try to make it my own. So as you navigate your way around simpler trading, just remember to always ask yourself, what is this person really good at? Try to take that piece from them, ask them questions, and then do that with every trader. And next thing you know, you'll have quite the collection of books in your own library. So a quick introduction, and really just a nod to the role that luck and chance plays in our lives. So before I dive into this, I want you to look over here. This is a print. I think it's called a lithograph. I don't know what that is, but it's a print, I guess, that John had in his office. And a couple of years ago, I was kind of renegotiating with Simpler Trading, and I said, you know what? I want that. Now, why did I want that? There's actually a story behind it. Many, many years ago, let me do it 3 times. Many, many, many years ago, I worked at Apple, and it was one of the more interesting jobs that I've had. I've met a lot of great people there. Maybe some of them are in the background today. And although Apple's a great company, I really didn't like my job. It was a salary job. I didn't work at the Apple store. I worked at Apple corporate, even more miserable, I suppose. And I wasn't really, liking the job. It was just something that I did. I actually have some great stories. Let me actually tell you this story. Let's start with a self-deprecating story. I'm the only person at Apple corporate, as far as I know, to ever get a triple final warning. Triple final warning. You get a warning, a second warning, a final warning, and then you get fired. I got a warning, a second warning, a final warning, a second final warning, a third final warning. Why did that happen? Well, because I never showed up to work. I was not a big fan. So early on, what I would do is actually, I had a shift from 8 to 5, and I would show up at 11 and leave at 1. Because I was trading the open and the close. But I was extremely good at my job, and that's why they allowed me so much flexibility. So going back to the painting here, or the lithograph, or whatever it's called, that used to hang in John's office. Now it hangs in my living room. But the story behind it is that used to be my background picture at Apple. And I never even knew who John Carter was. I never read Mastering the Trade. I'd never heard the name John Carter. I never heard about the squeeze. But that was my background on my computer at Apple. And then to meet John eventually, and to see that he has a bunch of art from this artist. And as I go through the presentation, you're going to see more art like this. I just thought it was really cool that now I work for the guy who has the actual, real life art that I had on my own computer at Apple. So Henry met John on a random call to his house to help install electronics with Geek Squad. So even, and I always say this, and I said this from day one, I'll say it today, and I'll probably say it 10 years from now. Henry's the best trader on the roster, and even his path has a large amount of luck and chance because he met John on a random call to help install something when he was working at Geek Squad. And then from there, they created Simpler Trading. So I didn't know Henry, but I was very close friends with someone who was friends with Henry. And so that kind of was my foot into the door into Simpler Trading. And so to go full circled from a job that I hate to looking at my monitor with that screensaver, to the luck of Henry, to the luck of knowing my friend, to the luck of being at Simpler Trading, and now for this to hang in my living room, it's pretty cool. More opening thoughts. So the first rule of any game is to know you are in one. Famously said by Sandy Lerner, co-founder of Cisco. And again, notice that the art is going to match as we go through the presentation. So why do I think this is an important slide? The first rule of any game is to know you are in one. This is going to be a common theme through the presentation. I want you to let go. Today, if I can sum up one goal that I have for you, you would imagine it would be to learn your indicators. It probably should be. This is an indicator class. Let's make that goal B. Goal 1A is let go. Let go of your biases, let go of your beliefs, let go of your need to understand. It's just a game. And I'm going to show you the ways that the game works and the ways that you measure the game. And then that way you'll be more comfortable letting all of the other things go. Before we start, I have a quiz, and whoever gets this right gets $1 million from John. And that is, can you find the elephant? Do you see the elephant in this photo? It is there. You just have to look closely. And if you're looking closely and you don't see the elephant, the rest of the room is laughing at you because we all see it. Why don't you see it? Have you tried turning your head or closing your eye? I mean, we all see it. You guys see it, right? So let's all point and laugh at the person that doesn't see it. The reality is there's nothing there. It's just a bunch of noise, right? And so humans will want to see patterns in noise that are not there. And our indicators are there to help us see through and avoid the noise. So this will probably be recurring theme 1C. Let's just go with 3. I'm going to lose track. This will be the recurring theme 3 of this presentation is let go. There's those 2 words again. Let go of the need to look for signal in noise. Accept the fact that the game is noise, right? It's called find the needle in the haystack, not 100 needles, pick one. In case somebody didn't get it, there is no elephant there. Somebody's like, I see it. Where's my $1 million? I want my $1 million. I see it. So there is no spoon. Instead of trying to find the signal in noise, avoid the noise completely. This is the reason that I developed the True Momentum system. So now we have a systematized way of not having to think about anything other than following our signal. So I'd like for you to maybe take a screenshot of this or just strongly maybe consider having it somewhere on your computer because it's going to remind you when you invariably overcomplicate trading. So here's the path that you're going to take. After this class, you're going to trade better than you've ever traded in your life. Why is that? Because I'm going to beat all of us, including myself, and I have enough belt for 100 butts. I'm going to beat all of us into following the signals. But here's what's going to happen. You will trade better than you ever have traded after this class because you will be following only the signals. And then what's going to happen? You will slowly diverge and start doing other things. And you'll get away from the signal. And so this singular picture will bring you back to the point. And the point is that if your system signal says to trade it as a long, all you have to do is trade long. If the system signal says it's a short, then all you have to do is trade short. If neither is true, and I'm going to show you what that looks like, and most of the time this is the default setting. This is a feature, not a bug. If neither are true, then you tell yourself, be patient. So what indicators will we be using today? So all indicators are available in your class folder. For the class, we will be using these indicators. We'll be using the 10, the 20 EMAs, and the 50 and 200 SMAs. We will be using the True Momentum Score, which is the buy and sell bubbles. We'll be using the High-Low Elite, True Momentum, Swing Levels, and the Squeeze. And it doesn't matter what version of the Squeeze you have. And frankly, it doesn't matter if you use the Squeeze at all. This is a squeeze agnostic strategy, but it is a nice thing to have. And it's built in, it's free. There's this artist again. I think what John did is he just bought this guy out. Like he had an office. This guy's art was everywhere. It was in the bathroom. Like it was John. I think just bought literally everything this guy has. There's another one. So I got to give you guys a little bit of vinegar at some point during this class. just a spoonful of vinegar, and then I promise you a mountain of sugar. And I debated whether I put the vinegar closer to the end or I put it at the beginning, but I think I'll give it to you right up front. So here's the little bit of vinegar that I have to do here. And try to understand where my perspective is on this one. So I have to align our expectations. And then after this, it's all mountains of sugar, I promise. We will be covering a lot today. So let's stay focused on the class topic, which is the indicators. Although we may cover topics such as day trading, in depth in terms of stops, option strategies, scans, Fibonacci, ATR trailing stops, macro, tech, and tech support, the goal of today is to ensure that all of you fully understand your new indicators. There are many trading resources on any topic you like. Today, we are here to fully understand your new indicators. Let's keep aligning expectations. Lastly, on this topic, before we dive in, do not send me an example of where the indicator did not work or trigger perfectly on a 1 minute overnight marshmallow futures contract. Somebody's looking up marshmallow futures right now asking, what's the ticker for that? For every example where it doesn't work or triggers late or early or not at all, there are hundreds of examples where it works better than anything else. I know what I've built. So, and I'm going to show you kind of the gaps here in terms of how to fill it in yourself also too. So the one time or the handful of times that it is going to be a little bit weird on a 1 minute chart, don't send me that. Okay, let's try to understand the big picture. No indicator works 100% of the time, and here's the key part. Release yourself from the outcome and trust the probabilities. Going back to this, since I'm giving you the vinegar here, I'll just finish it off. For the chat, let's be respectful somewhat of the chat. Let's not talk about tech support in the chat, please. There's nothing more boring and that will glaze over everyone's eyes than to have a long chain of tech support questions in the chat. Okay, this is not the time nor the place. Save it for Monday. And that's the vinegar. Now we get to be happy again. My goal for today, here's the mountain of sugar. Today you will be learning a new language. The basis of the new language will be LMT, level, momentum, and trigger. We will cover all of this today, but the focus is on momentum and understanding the indicators. Although we will cover many topics, the focus of today will be on your new indicators. Notice how many times I'm repeating that. My goal is that by the end of the class, you will be many steps closer to mastering the most sophisticated indicators that I have seen. So here's your class outline. This is everything we're going to cover. A couple of points here. We're going to cover day trading. We're going to cover strategy selection, which is options in terms of like butterflies, verticals, things like that. We're going to be covering scans as well. We're going to cover profit targets, and we're going to cover Fibonacci. Everything that I just mentioned. Notice I didn't mention everything. Just the parts that I just mentioned. These will be things that I touch on. Okay. I'm not here. This is not a day trading class. Okay. This is not a how do I set my stops and my profit targets class. I'm going to touch on those topics because I think they're important, but I really want to make sure that collectively, as the band leader for the day, the privilege of being the band leader, that I keep us focused on what really matters. Okay? So when I get to those points, just understand I'm going to briefly touch on them in the fastest and best way that I know how, but we are not doing deep dives into Fibonacci today. We're not doing deep dives into butterflies, option strategies, verticals, credit spreads, anything like that. What we will be doing deep dives into is the indicators, how to apply it, how to deeply understand it, and then my goal is that you'll understand the indicators so well that from there you'll be able to build out everything that you do. Keep in mind, trading is vast. There's a million things that you can do at any given time. And one thing that's really important, because I see this a lot, keep in mind, I see a lot on my end of the mic here, right? Much more than the average person. And so I can say this with a great deal of confidence. Approach trading as nature approaches evolution. What do I mean by that? I mean that nature rewards specialists. Okay? There's a reason that lions don't have wings. They don't need them. They are elite land animals. Now, if you take that lion and you drop it in the ocean, all of a sudden its skill set is worthless. Okay? So there's a million different ways that you can evolve as a trader. There's a million different things that you can do. My strong suggestion to each and every one of you, whether you've been trading for 30 years or 30 seconds, is narrow it down. So that'll maybe be continuing thread number 4 is I will always be telling you, narrow it down. I'm never going to tell you to do more. I'm actually going to tell you to do less. It's this really interesting thing where you start here, right? You're a wee tot, and then you evolve here to this point, and you're like, ha ha ha, this guy or gal, you knew nothing. Now I'm an adult and I know everything. And then you actually realize, oh, wait a second, everything that I learned is total bullshit. And then if you're really in tune, you make this final transition right back to where you started. So this is a recurring theme that I see in life and in trading. This is I need to know everything. This is I need to just master myself. Make sure that you're aware of that cycle. Part 1. Can you believe we're already here? Part 1. Again, remind me, somebody in chat, at when I need to take breaks, because I'm not scheduled for breaks. We're just, the train has no brakes, so at some point somebody's going to need to ping me if there's a time for a break, but I'll just roughly kind of look at the top of the hour. Part 1, why do we need 2 momentum indicators? So we're going to start really slow, right? I want to build you up because I need you to deeply understand this, right? I'm not here to tell you buy every buy bubble, sell every sell bubble, and never ever think, right? I'm going to kind of take a lot of the thinking out of the equation, but I want to build you up so that you understand what you're doing, so that you're not just clicking the button, right? There's a difference between, for example, a parrot that speaks. Does the parrot understand what it's saying? No, but you can teach a parrot to say almost anything. I don't want you guys. I don't want parrots. I want you guys to understand what it is that we're doing, and so I need to start a little bit slow to do that. Part 1: why do we need 2 momentum indicators? We need 2 momentum indicators because markets can move in any and all of 3 directions on any given day. They can go up, they can go down, and they can go sideways, and then most of the time they're actually going sideways. We need 2 momentum indicators to best understand these phases. If markets are going up or down, that's one phase. If markets are going sideways, that's another phase. Having 2 indicators covers us to trade in all market conditions. I always make the same joke. I'll make it again just so it's recorded and I can send it to my mom. I was trying to test her one day, and I was like, "Hey, mom, how many directions can stocks go?" And I was expecting her to say 2, up or down. She goes, "They can go up, they can go down, they can go to the right side, or they can go to the left side." And I was like, "Well, I've never seen a stock chart that goes left. I think if the stock chart starts to go left, you just invented a time machine." But I decided to give her partial credit because she's my mom. A reminder of why momentum matters. So a lot of folks are going to measure momentum in very basic ways, and there's nothing wrong with that. There's an input into my own system that uses basic. I just layer on significantly more sophisticated things on top. But a very basic way of looking at momentum or structure is with moving averages. And if you just have that, I think that that's just not enough. I think that's too simple. That's too basic. It's just not sophisticated enough. I think it's fine, and I do think enough of it to include it in my own system, and I'm going to show you actually how the calculations work. But you need to understand why the momentum matters, right? You need to be able to x-ray this picture. And this is just a chart that I saw of Google. This is an old picture, but I thought it was a good one. Here, Google looks like it's about to, keep going, stack moving averages, the charts from left to right, and then look what happens. It just falls apart. So we need to be able to x-ray that and understand what's going on, and that's why the indicators will provide us that second layer of sophistication to be able to do that. Part 2, price structures and squeezes. Keep in mind, we're starting real slow. We haven't gotten to the fun part. Overview of the squeeze. So again, you don't need the squeeze, but most of you are going to have it. The squeeze works by the idea of compressions and expansions. When a chart is in a squeeze, that means that the volatility or the movement of the stock has compressed. That triggers the squeeze. The idea is that price and volatility are compressed, and the squeeze shows a high probability of an expansion move coming. So we all are, hopefully are familiar with the squeeze, right? You have an up move, it starts to go sideways. It's kind of like a pressure cooker, right? At some point this has to go this way or it has to go that way, right? So that's basically the idea. No, look, I said pressure cooker on my own, and there it is. Red dots indicate the squeeze is in play. Green dots means that it's fired after a series of red dots. Also, the squeeze histogram gives valuable information about the direction. Squeezes typically go about 8 to 10 bars, so it's just a rule of thumb. And 8 to 10 bars means whatever that means on your time frame. So weekly is 8 to 10 weeks, daily 8 to 10 days, and so on. The Squeeze Pro versus the classic squeeze. So the premium squeeze, any variation, whether it's the Pro or the Ultra, is not required. There's no functional difference between the Squeeze Pro, which is what you're going to see me use in this class, and the classic squeeze or the MTT squeeze that's built into to TOS that is free. Both function the same and will look identical on charts. The difference between the Pro and the Classic is that the Pro offers more levels of detail on the compression of the squeeze. For the class, both versions of the squeeze will work the same, and I will be using the Pro version. So let's start thinking a little bit abstractly. So the next part is going to be us breaking down charts in an abstract way. We're going to deconstruct it, essentially, right? When you look at a chart and you see something like this, these are all different pieces of a puzzle that have formed together to become a puzzle, right? So for example, this is a silly example, I maybe shouldn't even make it. Let's say that you have a circle and a triangle, right? What am I trying to draw here? You can probably guess, maybe another triangle here, maybe some whiskers here, right? Silly example, I know. But you can deconstruct it and get it down to its component pieces, and then you rebuild it after you understand it. That's the goal. So the chart, we're going to break it down. In this instance, horizontal and support and resistance lines are the most important. Okay, so I know that it's simpler. We focus a lot on moving averages, but we need to add a conditional. Those are only good if you have a trend. The ones that should be the strongest of all are always horizontal supports and resistances. Okay, and that's what the swing levels is designed to cover. So I got you covered on that one with the indicator. The wings, the flexible part of the plane, or at least the bend, somewhat flexible, are the moving averages, right? So you have the fuselage, which is the hard part of the plane. This is the structure. You can think of it like the bones is going to be horizontal levels, right? Draw the horizontal lines, those are the strongest parts. But then you have the moving averages, which are kind of like the bone or the muscles of the metaphor, if you will. And those are moving and flexible. And then lastly, you have the engine, which is going to be the momentum indicators that we talk about. So in price structure and swing levels pro, again, this is all pretty basic, right? All the swing levels pro is going to do is just draw horizontal lines of support and resistance. The only thing that you need to know about this, we might have another slide later on. This might actually be the only one. So the only thing that you need to know about swing levels is it is customizable. So the bigger the number, the bigger the swing that it's looking for. If you were to make the number smaller, you can have it have swings. It would have a line here and here and here and probably here, right? You can do that. You just make the number smaller, right? But out of the box, I either use 50 or 100, but completely up to you. There's no wrong answer. And the main thing to take away from this slide is, again, this is the strongest forms of support and resistance. So It's more important than a moving average. It's more important than a Fibonacci, in my opinion. Horizontal support and resistance is very important. Oh, look, I actually talk about it. I should probably look ahead in my own presentation. Let me do that very quickly. Okay. So this is an example of the swing levels that I use, and these are the levels that I use. Again, I kind of front ran this slide. So there's no right or wrong answer here. Find what resonates for you. Pretty simple stuff, I think. Just play around with that experiment. Moving averages, again, 10 and EMA are going 10 and 20 EMAs are the most important for short-term trend. The EMA is viewed as the price mean. 50 and 200 SMA are the most important for holding and building structure that can support the shorter term trends. Okay, so good trends will go on the 10 and the 20. As we go along, you might say, well, what about the 8 and the 21? Completely interchangeable here, right? I use the 10 and the 20. If you want to use the 8 and the 21, just in your mind, auto translate that. But I'm basically talking about the same thing. And then the 50 and the 200 for holding and building structure. So building the structure. So here's a combined look at both previous highs and lows plotted by the swing levels and the moving averages on the chart. When you then start to combine all these pieces, right, notice how we started with those horizontal levels, we then added on the moving averages, and now we have bones and muscles working together. It starts to come together, right? The picture starts to build. So we combine both horizontal support and resistance levels. That gives us what, colloquially called price structure, which is the most important thing on a chart. Other things you could add is Fibonacci, voodoo lines, quant pivots, spot gamma levels, etc. But this is the basics of it. And then just a quick note. Actually, I don't want to front run. I think that comes up next. So part 3, understanding trend versus range. Keep in mind, we're still in the boring part, guys. But, this is, we got to build it up. We got to build it up because if I jump to the good stuff, if we don't do the foreplay, you guys aren't going to be ready for the big one. So understanding trend versus range. So we all are familiar with this. I hope uptrends are denominated by higher highs, higher lows. Downtrends are denominated by lower highs and lower lows. Compare that to the sideways chart, which is just a complete mess, right? Within reason. There's a clean high and a clean low, but everything in between is kind of a mess. These are two different market conditions. Make sure that you understand which one you use what indicator for. Maybe some of you can front run this and say, I would use this indicator, that one of your shiny new ones here. I would use this indicator, one of your shiny new ones here. And of course, I'll give you the answer later. Trending markets. We will define this more in detail later. The general definition of trend is a sustained directional move marked by higher highs and higher lows for uptrends and lower highs and lower lows for downtrends. Trends by their nature, and this is the key part, trends by their nature are the result of imbalance between buyers and sellers. The only way that you can have a trend up or down is that you have more pressure from one direction than you do the other. Sideways markets. The general definition of a sideways market is a market trading between previous highs and lows and usually has sideways moving averages, especially the 50 and the 200. By its nature, range or chop is the result of balance between buyers and sellers. Most of the times, markets are actually trading in this modality. So understanding trend versus range. So all trends are imbalances in the chart. Trends begin by an imbalance of buyers or sellers, and that imbalance sustained over time is what will create a trend. Trending markets tend to offer the best directional moves as the market has already shown imbalance of buyers to sellers and has investor interest. In trending markets, moving averages will become more reliable and stronger forms of dynamic support. That's the key part on that one. In trending markets, moving averages will become more reliable and stronger forms of dynamic support. All ranges are balances in the chart. Ranges are established when the interest of buyers and sellers is about equal and neither side is able to break the upper or lower trading range. Ranging markets tend to offer the best back and forth between up moves between the upper and lower ranges. In range markets, and this is the key point, in range markets, moving averages will become less reliable forms of support. In that instance, we use highs and lows, static support, or swing levels in these markets. And now we get to the little bit of the fun part. We just graduated from preschool. And if you guys are asking questions in the chat, just be aware that I'm actually not necessarily looking at chat. So if you can, anything that you're asking questions about, just jot it down, save it, and then we'll do a big deep dive at the end. The reason is I want to preserve the integrity of the recording. And if I'm stopping to answer random questions in chat, I think that creates a negative experience for yourself when you watch this later, or for anyone who's going to watch it later in general. So just be aware if you're asking questions about anything. I'm not looking at chat. I will, now that we're into the fun part, which is the indicators, I will actually take moments to, see if there are any questions. But if I haven't asked, does anyone have questions, be aware that I'm probably not seeing your question. So if you have one, maybe just put it in queue, and then when I ask, does anyone have questions, fire it out there. Or at the very end, we're going to have hopefully a very deep dive Q&A. So the true momentum, what is it? It's an indicator that's used to qualify short-term and long-term momentum, the X-ray of momentum. The extremes are marked by the upper and lower white lines accompanied by a midpoint. The true momentum works in trending markets, showing moving average alignment best. And this is key because you're all going to be using this. True momentum is the most important indicator of the system by far. And it'll make sense as to why, because I'll show you the calculations later. This is the most important indicator on the chart. So in terms of order of operations, I make sure that I have it above the high-low elite, because I always want to be focusing on true momentum first, high-low second. When to use it. The true momentum is designed to be worked best in a trending market. We define trend by higher highs and higher lows for uptrends and vice versa for downtrends. We also want to see moving averages that show trend properties angled up or down, not sideways, stacked fastest to slowest, or vice versa. So basically what it means is the indicator, the true momentum, is going to work best in a trending market. That's your tool for that type of market. The high-low will be your tool for the other type of market, which we'll look at later. So the slow line. So the slow line is it's the slower one of the two, frankly. The first thing we will look at is the shape of the slow line. So we want to see an upsloping slow line for a strong bull and a downsloping slow line for a strong bear. So here's kind of a quick aside. The indicators have the buy and the sell bubbles, right? That's going to take care of almost everything for you. The reason that we're doing this is that so that you have a deep understanding as to what's going on, what really is going on, right? There will also be times or slides where I'm going to go way beyond giving you information that you even require. And I'll tell you that you don't need to know that. Now, it's an interesting thing, because when I get to those slides and I tell you won't need to know that, some people will pay even more attention. Just the nature of the beast, right? If I tell you it's don't go into the forbidden closet, everyone wants to go into the forbidden closet. So is this something that you absolutely need to know? Yeah, I would say so. These parts here are pretty basic, and these are things that you need to know. They shouldn't take up a lot of space in your brain. I think a lot of this stuff is generally self-explanatory, but there will be a point later in the class where I'm going to go way overboard with how everything is calculated, because at least one of you is, as neurotic as I am. But I'll tell you, you don't need to know that. Here, I would say that you need to know all of this. And it's pretty simple. I mean, this isn't anything that's rocket science, right? You just want to see the slow line going up if you have an uptrend. Right? All right, so that deserved a whole slide. So what does it look like when it's trending? So the shape of the slow line when it's trending will obviously have a distinct look to it. And it'll look kind of like this, as a very good example. So qualifying the uptrend, what does it look like when it's uptrending? For strong uptrends, you will see slow line that is sloping up and climbing, a fast line above the slow line that's also climbing. You're going to find that the fast line finds support at the rising slow line. So this is kind of where it starts to get interesting. So I think everybody would be aware that this is probably an uptrend, right? You don't even price. You know, if I just showed you that, you'd probably say that's an instrument that is uptrending. The key part is that what happens here. You see where the lines meet? What happens there? Well, in good trends, the slow line will act as a support level for the fast line. So when the fast line comes into the slow, it should hold and then go back up if the trend is good. If not, then you'll either see kind of something messy where the lines will chop around. That's going to be suboptimal. Or worst case scenario, you'll see something where they cross and actually do something different. But in general, if the trend is any good, you would expect to find support at the reconnection of both lines. So this is just the same thing in opposite, right? Qualifying the downtrend. So for strong downtrends, you will see a slow line that is sloping down and falling. Fast line below the slow line. This is all taken care of by the color, so it's just going to be double red. You know, it's really just that simple. It's going to be double red. What's actually kind of funny, guys, is that we're all going to collectively go on this journey where you're starting off, you're fresh, you're here, you know, you just got the indicators. Maybe you got them after webinar 1, which was about a week ago. Maybe you got them 5 minutes before the class. And so you're like, okay, let's go. I want to learn everything. And then we're going to go through this process of showing you everything. And then guess what's going to happen? You're going to come right back to the very beginning and simplify everything as if it was, you know, day one. And that's going to be a beautiful thing. So we're still in the phase of giving you everything, right? You can't go to phase 3 without going through phase 2. But just be aware, the the enlightenment part of this indicator set is when you actually go full circle and say, let's keep it simple. Right? And initially, your instinct will be to add more, to do more, to do more, add more. Eventually, once you reach enlightenment on the indicator, you'll come full circle and say, both lines are red and they're falling. It's a beautiful thing. So what does it look like when it's sideways? So it just looks like a mess, right? You can see here. And I also think it's important to look at the totality of the line, right? So, you know, you could look just this bracket, but in reality, you kind of try to train your eye to look at the whole thing. And you see how neither side's ever able to gain ground. Also notice how the slow line's basically flat. So while there are spikes in either direction and crossovers in either direction, notice that the slow line is basically flat. That's essentially what it'll look like. Traded as such, most of you will want to avoid this. Some of you will want to trade it at the top and bottom of the range, but the main thing to do is to not confuse it with trend and start, you know, doing trend-like strategies for that type of market. So when true momentum is messy or neutral, when the green crosses back and forth through the slow line, we default to the shape of the slow line and the position of both lines. So always ask yourself, if necessary, where are both lines? Now, if you've gotten to the point where you're asking yourself where are both lines, chances are you're looking at noise. Make a note of that, by the way. If you're getting to the point where you're doing all of this micro analysis on this, chances are you're looking at noise, and you probably need to move to something better. But the position of the lines also matters, right? So are they staying above 50 or below 50 is going to give you a clue. And this is a really important part, so make sure you make a note of this. When the true momentum is messy or the red line is flat, we rely on the high-low to signal thrust. A very simple rule, very simple and powerful, and this will fill in a lot of gaps. We're going to cover it a lot more later. If the candles are gray, and especially if the candles are gray and the true momentum label says neutral, which is also gray candles plus gray neutral label on true momentum means immediately to look at high-low, and that's your signal. Oh, what do you know? I gotta start. I got to stop front running myself. Holy smokes. This is such a cool slide too, and I just front ran the the hell out of it. All right, here we go. Oftentimes, the readings on true momentum will result in neutral bull or neutral bear readings. Neutral readings would look like a flat, slow line. Basically, everything I just told you, just in more elegantly worded bullets. Sloppy, fast, or slow dynamics, up and down, up and down. One line above 50, one line below 50. These are all things that will trigger neutral readings on the true momentum. And that's okay. That's going to happen most of the time. Keep in mind, most of the time, it's called finding the needle in the haystack, not go pick a needle out of a stack of needles. That's okay. That means that trend momentum is neutral, and we look for thrust momentum via the high-low. So you just heard the same thing twice, but this is a cool picture, so I thought I would include it. The labels. So the labels here, you're going to see three different variations of labels on your true momentum. They will either be green, which means that the fast line is above the slow line within a specific range. It does have to exceed the line by a certain range to trigger the green. Be aware of that. Red trend, fast below the slow line. It'll be red, and then neutral, fast above or below the slow line, but they're too close together. That the trend is neutral. So in that instance, use high-low. Basically, this would be, and this is a signal. This is a signal. This is a signal to look somewhere else. Think of it that way. So the way that it shipped was with a asterisk. You don't need to know this, but TOS has some problems exporting special characters. So as I go along, and maybe I should just do this for the class. All right, fine. I'll simplify all our lives. Just a heads up. Maybe I shouldn't even say this. This is what it was designed to look like. It was designed to be a little pretty check. It is on my end, but if I export that, it doesn't export. It exports as an error. So in the interest of getting us all aligned so that nobody gets questions on this later, let me change my true momentum from my beautiful arrow, which I love so much, to an asterisk. I want us all to be aligned here. There it is. All right. So let's get down to the nitty gritty. The momentum label. Sometimes it's going to have this little guy here. Sometimes it'll have just Momo, but then sometimes it'll have the asterisk. What does that mean? The asterisk means that the reading of the fast line is above 70 or below 30. So when the mobile label shows the asterisk, it indicates that the fast line is above or below 70. The reason that I think that's so important is because that's one, it is a good sign, right? It is a good sign. Don't view this as overbought or oversold or anything like that. I don't necessarily like thinking in those terms when it comes to this particular indicator. Being up there above 70 is an accomplishment and it is a good thing. But I do want you to be aware of this. The lines, the white lines, the reason they're so fat is because I want to remind myself all the time that they are actually, or they can be, support or resistance. So meaning that oftentimes 70 will be the line in the sand. You'll see things go up to 70 and fail. Okay. Now that should be the expectation, but then sometimes things are really strong, and when they are able to get through 70, then that's actually really good sign of trend strength. So this little asterisk here is just your heads up to make that determination if that's something that you see fit. This is coded to be a somewhat rare event. Momentum reversals can happen at this level. Again, I keep front running myself. So the asterisk says to watch this, but in general, this is a strong position for trend. Another label you might see is the extreme label. So when the print, the extreme label prints when the fast and the slow lines are above 70 or below 30. The Momo label will also show two asterisks. So basically think about it like this. One asterisk means one line is above the extreme level or below the extreme level. Two asterisks means both lines. It is a little bit redundant in that the Momo label will have two asterisks and then say extreme as well when the second slow moving average crosses 70, but it is actually a very rare event. It doesn't happen very often, so be aware of that. Usually it's also a bullish event, but also typically somewhere where I'd want to start moving up stops. So this is coded to be a rare event. This is a strong position for trend. Overbought and oversold is a good thing. Greed is good, I'm told. Can persist much longer than you think. So it doesn't mean, oh, both lines are above 70, time to get short. What it does mean is if you're in the move, just move up your stops. You don't want to have wide stops when the extreme label is lit up. True momentum has an interesting property that's uncommon but carries significance. I used to call this redlining. I don't have a term for it anymore, really. But it's let's just go with redlining. Redlining is my term for when the slow line hits or crosses the upper extreme, 70 or 30, and this is a rare event and indicates an extreme level of overbought or oversold conditions on that time frame. I'm using the words overbought and oversold as purely as a vehicle of communication. I don't necessarily love those terms, but just in terms of communicating an idea, the general gist of it, it generally captures it. But what I don't want you to think is something's overbought, it has to reverse. In reality, actually, you might, with this indicator, you might want to say it's overbought, it's going to continue, right? So just the shift in the frame of the traditional definition of overbought and oversold. And this is not itself a buy or sell signal, but it is a very rare signal that should be watched carefully for any momentum breaks. When you spin a top, you don't need to wait for the top to fall. The moment that the top, the spinning top, wobbles just a little bit, it's over, right? It's just a matter of time before it falls. So you don't need to say, well, I'll wait for it to fall. You can wait for the wobble, and the fall is invariable. So in that instance, the way that I handle this kind of stuff is actually just ratchet up your stop so that you don't have a wide stop in that scenario. So this is a cool one. Many of you have seen this one, and this one deserves your attention. And I designed it in a way that it would grab your attention. It's red and it says caution, so it's certainly provocative. It gets the people going. Caution label. It prints when the slow line is above the fast line, with a slow line a slow line above 70 and the fast line below 70. So this is a good example. So here you have a ideal trend, right? Just beautiful, beautiful stuff. And you see how here both lines go above 70. Look how much longer they stay above 70. This is why you don't necessarily want to look at overbought as a negative thing, because if you're shorting that, that's going to be very annoying. So just wait for your signal. Also, one last thing, notice that the spread here of these two lines is pretty big. So you typically don't want to short that either. You want to wait for your shorts when the lines are about to break like that. So just a little bit of a heads up there on that. Let me start over on this one because it deserves attention. Caution label. Prints when the slow line is above the fast line with the slow line above 70 and the fast line below 70. So this is the fast line. It was above the slow line. In this moment in time, you see how they flipped. They do go red, so it's very obvious. You do have a down arrow and they go red. Can't miss it. But this moment in time I thought was actually so significant that it deserved its own label. And it lights up as caution. And it's actually a really good signal. Actually, the only time I haven't seen it play out was recently during the QQQ gamma squeeze. That's the only time I have not seen this signal work. Every other signal, every other time I've seen caution labels, I've made like a good amount of money shorting that thing. Like we actually had a trade together on Lilly in the room. This was like a few months ago when they reported earnings and they had the worst down day in their history, and we were short for that. The signal for the short was actually this. Another time that it happened was on Palantir. Palantir had the same signal, shorted it, did well. Netflix at its highs had this exact signal, and Netflix got wrecked after that. The only time I have not seen this signal work in a dramatic way is actually on the recent QQQ gamma squeeze over the last 6 weeks. But trading is probabilities. So just the fact that it didn't work that one time, I'm not going to throw the thing in the bin because it's worked literally every other time I've seen it. So be very aware of this one. I'm spending additional time on this one so that you can become a master of it. And really what I want you to do with it, because this is only one slide. You can probably memorize every word on this slide in 5 minutes. The game is not memorization. The game is not reading your book 100 times. The game is doing this in real time with real money. So as you progress through your own charts and your own positions and your own trading, watch these signals and slowly start to build up your own knowledge base as to how this plays out. Why is this so dangerous? See if you can kind of figure it out on your own. You don't have to put it in the chat because I'm not looking anyways, but think about why is this such a dangerous signal? Why am I spending so much time on this? And why did I think so much of it to code a specific label just for this condition? See if you can kind of figure it out in your head why this is such an important signal. You don't have to put it in the chat. I'll tell you. The reason this is such an important signal is because now the slow line is above 70, which is like, we talked about that being extreme, but now the fast line has broken below 70. So this is like the equivalent of like blowing an engine or maybe blowing both engines on a plane, right? Like you have all this altitude and now you've completely lost your your power, your the thing that's propelling you forward, which is the trend. And so typically what you'll see is that when this happens, the resolution is very sharp to the downside. Okay. So really, and it's a cool signal. It's one of my favorite ones. So when it's and this is an important thing too. When it's in on the upside and it's bearishly cautious, meaning that you should be cautious because it's going to be a potentially bearish move to a sharply bearish move to the downside, the label would be red. And this indicates a potentially very bearish setup until it's resolved. There is actually a flip side. It actually can print green, but it'll print green off the lower. So it's everything I just said is just flipped, but it's on the 30 line. And it would be a green caution label. Those are going to be somewhat more rare, to be honest. Prints a green caution label, and it's actually a potentially very bullish setup. So it cuts both ways. Both labels are going to say caution. It's just the color that will designate what whether it's bullish or bearish. Okay, so I'm kind of looking ahead here to see where we can take a break. Actually, we're close. Let's blast through the rest of True Momentum, and then I'm going to be conscious about giving you guys a break and potentially refilling my stiff drink. I'm having 80 proof glass of milk. Alrighty, so we're still building up the labels, okay? In terms of, so you can understand what they all mean. So then there's also going to be an ATR label, and that label is always on. It'll always be green or red, and it's very simple. There's a calculation running in the background of the true momentum that is always calculating where the trailing ATR stop is. If it's green, that means that price is above the trailing ATR stop. When it's red, price is below the trailing ATR stop. In general, you want to just go in the direction of this. The ATR label is, of course, colored in to tell you that price is above it or below it, but then it also is going to factor into the score. So it's a double input, but you don't actually necessarily have to think about it because it's all being done automatically. Just be aware of how that works. So you generally want to go in the direction of this. You do not need it visible on your charts. The indicator is doing all of the work under the hood. Let's see if there's the next one here. All right. So maybe you can play around with this later. I wanted to include every setting that I use. Again, I told you guys I was going to open the kimono, and I'm going to maybe open it a little bit more than you expect because I'm going to give you like way more than you think you need, or way more than I know you need. Let me put it this way, way more than the average person that's going to use this strategy successfully will need. I would say probably 98% of you will not need some of the things that I'm going to tell you later. Truly. But I'm going to give it to you all just so that, you know, the 2% are happy because I'm part of the 2%. I'd be like, I want to know, but also accept that you don't need to know. That's a big deal too, right? Keep in mind the main goal of today, you would think, is to use your indicators. Remember? Anyone remember the number one goal of today? I am actually looking at the chat for this one. Anyone remember the number one goal of today? The indicators are number two. There you go. You guys are paying attention. I love that. Let go is the number one goal of today. Momentum labels, ATR trailing stop settings. So this is what's running in the background if you care to know. I'm actually tempted to show it to you, so let me just throw it on. Now, I do want to be clear that I'm not going to do a deep dive on this with you, right? I'm not here to, this is not a trailing ATR class, nor does it need to be, frankly. But I do want you to see it because it's kind of cool. So the trailing ATR stop is these dotted lines. Let me see if maybe I can color them as a line. Let's do that. That'll generally be working. Oh, that's good enough. You see this stair-stepping green thing here? This is the trailing ATR stop. You don't need it on your charts. You can have it if you want. I actually do have it on some charts. I find it pretty valuable. But it's all running in the background. And essentially what the ATR label is designed to do is to say, where's the trailing ATR stop? It's these green dashed lines. And is price above or below that level? And then, of course, it'll give you the green kind of symbol of that you're good to go on that. So I do enjoy a good trailing ATR stop. The next labels that you're going to see is going to be the trap labels. And what's kind of cool about this is I think I actually undersold these because I was driving around yesterday. I was thinking like this trap label, it actually is, it's enough code just for this label that it could be its own indicator. And I just decided to go ahead and put it into the TrueMomentum as like a accessory, which is kind of cool. But there's a lot of code that goes into this, and this is not easy to code, by the way. Like, because it's hard to get it right because what you're trying to do is this is a price pattern and it's a visual price pattern, so it's very difficult to turn visual input into coded data. But for the most part, it actually came out extremely good. So you're going to see these sometimes, and I want you to know what they're about. You're going to see bull trap and bear trap. Bull trap label shows when the price breaks above a swing high and then reverses back below. Bear trap shows when price breaks below a swing low and then reverses back above. I'm actually going to show you a picture here, so you don't need to visualize it. The label will stay on, and it's always going to be gray, so never assume that it'll light up red or green. I considered making the bull trap, which is actually paradoxically a bearish signal. I considered making the bull trap red and bear trap green. I decided against that because, and this is really important, and here I am front running my own self on this. I'm starting to front run myself on the very slide that I'm on, which is impressive. I was front running myself from like a slide or two to come. Now I'm front running myself on the slide that I'm on. So maybe I should just read the slide. The label will stay on until either price breaks the level that initially triggered it, or 5 bar on a daily or 8 bar on an intraday timeout. So if 5 bars pass on the daily, it'll just time itself out. If at some point the level that triggered it is broken, it will just turn off. The trap, and this is important. Let me show you the what this means first. We'll kind of come back to this. So this is going to trigger a bear trap. If you want a perfect example of this in real time, jot this down, study it later. IGV daily chart has a perfect bear trap. It almost looks identical to this textbook example, to be honest with you. Actually, it looks even better than this textbook example. No, like it looks about the same actually. It's almost perfectly textbook. So the trap, and again, you don't need to know this. Actually, no, you do need to know this one. You actually do. Yeah, no, on this one, pay attention because although I'm giving you the label, it's super important that you are able to then very quickly assess the situation. So the label is your first step because, you know, I've gotten really good at finding these with my eyes, but why not have a label that you can just look at from across the room and then that gets your attention. So let's talk about this for a second because you absolutely need to know this. This is the most important price pattern that I know of. And this is what it looks like. You'll create a line here, right? You have a previous low. You break the low, right? Here, this creates the trap. Open the kimono. Out of the corner of my eye, I see a Bucky's kimono. How am I not going to stop and acknowledge the Bucky's kimono? Anyways, you break the low, you then pop back above the line, and then you look to target the swing high and break out. So this is actually a pretty textbook example too. Super important pattern. Let's go back to this for a second. 2 points that you need to know. One, the most important pattern that I personally know of, it is extremely potent if you see a bear trap on an intraday futures chart. And this is really important. The trap labels are inert. So what does that mean? They only signal a pattern to note and to raise your alertness. Higher time frames matter more. So the way that I describe this is think of these as like gasoline. I pour gasoline on the chart, right? Now the chart is covered in gasoline. Is it on fire? No, it's just soaked in gasoline, right? It has the potential to be on fire in quite a considerable and dramatic way, but it is not on fire, right? It's just soaked in gasoline. So that visual will make it make sense. The trigger for this is when you start getting breakouts, then the fact that it's a trap will exacerbate the move. So we talked about this one as well. Just so you're aware, the label will turn off after a timeout of a certain amount of bars, or if the level that created it gets invalidated. So if price were to do this and then that would invalidate the label. And we're close to a break, guys, so don't worry. I got you. I didn't forget about that. So momentum divergences. So the positive divergence label shows when price makes a lower low and true momentum makes higher lows. Negative divergence label will show the opposite when it makes higher highs and true momentum makes lower highs. And the label will stay on until 20 bars passes for it to time out. Again, the divergence labels are inert, similar to the trap labels. They're just accelerants. So whatever you see on a chart, if there's a trap label or a divergence label, it plays out faster, right? Think of kind of like a squeeze, right? Squeezes are kind of similar. If something has a squeeze, it doesn't tell you anything. It's a neutral statement. However, we are all familiar that squeezes create more potent moves once they trigger. Same idea with this. So the white lines. We'll blast this one. So true momentum can have support and resistance levels. Watch for these levels marked by the upper 70, middle 50, and lower 30 lines. You don't really need to be as deep as this. You'll just intuitively start to get this. So you'll have muscle memory for all of this. So don't get too bogged up on this because this is just going to be as natural as it comes once you get a couple of reps under you. I just think it's important to talk about each individual piece, deconstruct everything. You can see now why the indicator took me so long to build and why it is of the sophistication that it is, because I deconstruct every atomic piece and then rebuild it from the ground up to a maniacal level. So this is the way that I present it so that you can atomically understand it and then we can build from there. So most people would skip this, but I won't because although it is intuitive, it's important. So these can be inflection points as well. So again, you can find resistance at 70, 50, or 30. There's a reason that these lines are so fat. However, strong momentum will go through these levels. So if you find that your fast line goes down to 50 and holds, that's a really bullish sign. If you find that your fast line goes up to 70 and fails, that's a really bad sign. If you find that your fast line goes down to 30 and bounces, that's the beginning of a reversal. If you find that your line goes from 30 to 50 and fails, that's the beginning of a downtrend. The slow line, everything I just said, I just ran myself for the 50th time. Bull and bear zones. So always ask yourself, where are both the green and the red lines at the moment? If they're both above 50, it's bullish. If they're both below 50, it's bearish. Honestly, the label takes care of a lot of that for you, but just so you know, neutral bull can move higher, but in a sloppy and weak way, meaning it won't be pullbacks to the 21 kind of thing. Neutral bear would do the same, just inverted. Neutral weak trend markets are better for high-low pro. Again, the one thing I want you to take away from this, we talked about a whole lot here. Let's simplify it to its most simple piece. And you don't really have to even think. If the color is gray on True Momentum and it says neutral and you have gray bars, what do? You fall back to the high-low. That's what this entire section was about. Gray label, gray bar, use high-low. Momentum shifts. So this is all pretty straightforward, I would imagine. When you get momentum shifts, the lines will change colors. You'll get an arrow, and then you see how the red line here is trying to get back above, and it's finding resistance. That's a big signal here. It may not come across. This is a more advanced signal. You will not get any label or arrows, but you see how the fast line is trying its very best to get back through the slow line. It fails, rejected, rejected. Think of price resistance. What does it look like? You go up, you get rejected. You go up, you get rejected. You go up, you get rejected. Finally, it fails. Same exact thing, same exact principles, just on an indicator instead of price. So trend shifts are pretty easy. I won't spend too much more time on that. Divergences, we've already talked about that, and there is now a label for it, so we do not need to further dive into this. I'll just cover this. So the label does cover you, but it's not going to be perfect, right? It's these labels are not. I'm coding abstract visual things into a label. So I've mostly succeeded. I'd say probably 90% of the way, but things do get through. So I want you to still be able to, at some point, spot these things. So price will go up, indicator goes down, the pullback will not be supported, and it falls apart. It's as simple as that. The label will take care of you the vast majority of the time. This is just here to show you an example. Positive divergences, same exact thing. Price down, indicator up. You see how it doesn't do anything and then it explodes? That's the gasoline. Divergences, gasoline. Putting it all together. So this is the last part, and then we're going to take a break. So questions to ask yourself. And I'm going to give you a lot here, but this is just a checklist that you're going to have muscle memory. My goal is that you'll have muscle memory for all of this as soon as possible, and you won't actually be asking yourself these questions. You'll intuitively just see it because you've done it, because it's just clear and you've done it enough times. What is the shape of the red line? Are both lines above or below 50? Are both lines trending messy or are they clean? Are they near the top or the bottom, 70-30? What's the distance between the lines? And do you see divergences? This is the checklist from the previous iteration of it. In reality, everything that I just showed you here, which is actually insane that I'm about to say this and mean it, because I hadn't thought about it since, and I'm going to have myself a little toast because this is extremely. I just got this moment of like the moment just hit me. All of this used to be manual. Let me update the slide. That's what you need to ask yourself. Nothing. It's all coded in. It just actually hit me. Wow. It's It's all coded in now. It's okay if the signal says neutral. Trust the signal. If you need faster or different reads, switch the time frames. That's the takeaway from this slide. If you, the best thing that you can do is just find the time frame that has trend, right? If you're looking at something that doesn't have trend, drop a time frame up, or excuse me, go a time frame up, like daily to weekly, or go a time frame down. If you can't find a time frame that has trend, don't trade it, or don't trade it as you would trend. So this is something that we'll cover later in the class. I think this is a great time, guys, to take a break. So let's do that. When we come back, we'll cover high-low, elite, and we'll keep building. See you guys in about, what do you guys think, 10? We good with 10? Yeah, let's do 10. Okay, see you guys in about 10. My goodness. They don't make them like they used to. So many bangers. One time I had a dream that I was at my own wedding. So we're already in the land of improbabilities. I was at my own wedding, and I get up and I do a fully choreographed version of the Beat It dance. I was like, well, wedding or no wedding, I gotta learn that dance now. All right, so we are now about a third of the way through. So let's dive in. I'll wait another 30 seconds or so. I was trying to put up a timer, but for some reason I couldn't. So I'm just gonna give it another 30 seconds or so. Just let anybody else who's grabbing coffee or something get back to their seat. And then we're going to cover the high-low elite next, and then we're going to start tying it all together. I think the fun part really will be probably the Q&A and doing chart reviews. I think that that's really where I probably want to spend the most amount of time, because that's reps, right? You know, I talk so much about you just got the golf clubs and we need to go out there and swing them, and the chart stuff is the reps. So this is the book that goes with your golf clubs, but the real progression will happen when you actually start swinging them. So we'll give it another, we'll start at 128, so another 20 seconds. Alrighty, so everybody's back. Let's start part 5, high-low elite. What is it? So the high-low elite is the range indicator, and what it really is a custom slow stochastic with variable dynamic triggers for anyone who's interested. Our primary indicator when true momentum is neutral, gray, is the high-low. So think of high-low as a way to measure thrust more than just a buy or sell arrow. It's not intended to be a buy or sell arrow. Everything's a lot more integrated and a lot more holistic than just that. But it is a major input into the score. So think of it kind of like, where's the pressure right now, right? So the arrow tells you where the pressure is. When combined with trend, the thrust signals are actually stronger. So that's one thing that's a little bit different than my oscillator, than any other oscillator that I've seen, is that mine actually works very well in trend. The interesting part about it is that it doesn't oscillate up or down like a sine wave unless it needs to. Most oscillators always have to oscillate. Mine actually doesn't. So paradoxically, it is a range indicator, but it's even stronger in a trend. When to use it? So you rely on high-low when the moving averages are sideways, when true momentum is neutral, when true momentum slow line is flat, or true momentum reading is messy. In general, really there's 4 points there, let's condense them. You rely on high-low whenever the true momentum is neutral. If the true momentum is neutral or is weird in any way, just fall back to the high-low. And here's me front running again. Before we go to the next slide, I just want to confirm, is the audio 9.15 or better? It should at least be 9.15. Okay, good. Thanks, guys. Sometimes it goes to the computer mic. Understanding the green line. So in a range-bound markets, the green line will tend to ping-pong between the upper and lower white lines. So when you're range-bound, you'll bounce between 80 and then 20 and then 80 and then 20. In weak trending markets, the green line will stay on one side of the 50 line. So if you're bullish, you'll stay above the 50 level. So you'll fall from the top, you'll land at 50. 50 will be support, the middle will be support, and then you go right back you go right back up. In strong trending markets, the green line will stay pinned to the very top or the bottom without crossing. So that's what that looks like. And that's a strong trend. The white lines, 20, 50, and 80, can act as support or resistance at the upper, lower, or middle edges. Strong thrust will find support at the top before resuming. This is like the strongest of the strong. So if something falls to 80 and then prints another buy signal, that's like as strong as it gets. Good thrusts will find support at the 50 line. Okay, so it's just a matter of where does it find support. Great thrusts or strong thrust in strong trends will find support at 80 or 20 for bears, and then average run-of-the-mill trends will find support at 50 on either side of the line. The thrust signals. So the arrows show momentum shifts. The direction of the last arrow is the color of the thrust label. So if the last signal or the last arrow is up, it'll always say green thrust. If the last signal was down, it'll always say red thrust. This is pressure thrust momentum shifting in a sudden way, and it usually precedes trend momentum. So I have this weird kind of metaphor down there. I don't know the difference between metaphors and analogies. Let's go with, let's just say analogy. I don't know what it is. Plane on the runway. Okay, so you're a plane on the runway, and your goal is to do what planes do and fly. How do you get there? Well, you need a lot of thrust to go down the runway, right? That's going to take the most amount of energy. You got to get those engines spinning up. They're going as hard as they can. They take that heavy-ass plane, lift the nose, and off to the sky it goes. If abstraction helps you, that's what high-low is designed to do. It's telling you, you got that thrust. It's trying to go, lift the nose, take off, and then once you're in the sky, in this obtuse metaphor or analogy, then the true momentum takes over. So think of it as a process of operations. High-low will trigger the burst, and then trend momentum or true momentum will carry the plane to the destination. One moment. Let me just clear my throat. So the thrust label. Prints green or red, thrust based on the last direction of the arrow. Very simple stuff here, guys. If the last arrow is up, thrust label prints green. Last signal is down, label prints red. But that's not enough. Confirmed. So you'll see the confirm label, and it'll always be there, and it'll either say confirmed or not confirmed. How many of you have asked the question, what does it mean when it says not confirmed? I would imagine that's a question I would ask. Well, let me tell you. So high-low confirm label, it prints confirmed or not confirmed if the hidden secondary oscillator is aligned in the same direction of the last thrust signal. This is a key component as confirmed signals carry more weight in the scoring system. So again, this is all automatically done for you. The calculations, the math, everything is already built in. But we're trying to understand it so that we're not just, the parrot that is saying funny things but doesn't actually know what they're saying. Unconfirmed pullbacks in trends are likely setups to buy. So that might be a slightly more intermediate level of understanding, but write it down for later. Unconfirmed pullbacks in trends are more likely setups to buy. Unconfirmed pullbacks means that you have a down arrow, and if you're in a trend, it'll likely say unconfirmed. That down arrow is likely setting you up for a pullback into a buy zone that that then you'll get another arrow to the upside that'll complete the burst to the upside. We'll come back to this dynamic around the two lines. You see how there's two lines here? Let me just look ahead real quick. Okay, maybe it's worth explaining it as long as I'm here. So as long as I'm here, you will not see two lines on your high-low, right? I exposed the secondary line so that you can see what it's about. So this is the high-low line. This is the hidden signal underneath it. If both lines are aligned, see how they're green, double green, it'll say thrust confirmed. Basically this. If it's in this condition, you see how the arrow triggered here, this line is green, the line that is visible to you is green, but you see how for this until it crosses here, this line was red? That would say unconfirmed. So confirmed signals are actually significantly more valuable. Later on, I'm going to show you how to enable the second line, but I'm also going to very strongly suggest that you do not do that. So I'm spending a little bit more time on this so you understand, because this is a, by default, hidden secondary oscillator that's running in the background. But I just want you to know what it is, how it works, why it triggers, why it's so important. And then later on, I'll show you how to add it if you want to play around with that idea. So this is another one, and it says thrust and then the asterisk. So if the last signal was slingshot thrust, then it will print as a asterisk next to thrust. So what does that mean? Well, this is an old photo, so your indicators are not going to look like this. You see how many arrows there are there in different colors. But I kept it here, the old version, because it shows the idea. For those of you that took the previous class, we called it judo. You can call it slingshot. You can call it a ham sandwich. It doesn't matter, as long as you understand the principle. So the principle is this right here. You see how it gave a down signal, and then it gives an immediate up signal within 1 to 2 bars. The very next bar, it gave an up signal. So this is important. Down signal here, up signal 1 to 2 bars later. That is called slingshot or judo or ham sandwich. For this class, we're just going to call it slingshot. Although I'm open to the idea of calling it a ham sandwich if you want. Why is this important? Because this is actually a pretty good signal. Now, do you need to be able to see it? No, you actually don't. It's coded in as well. So it'll say thrust and it'll have a asterisk next to it. That tells you that the last signal is that slingshot signal. Slingshot thrust happens when a signal fires in any direction, and then within 1 to 2 bars, the opposite signal fires. So the way that you think about it is that when you see thrust with an asterisk, think of it similar to a squeeze firing, right? You have this kind of coiled energy, if you will. It's different than the squeeze because the squeeze works on the premise of it's really, really tight and then it goes. This works on the premise of somebody got wrong-footed. So in the same way that judo would use like somebody's body weight against them, so you could take like a 100-pound woman and a 300-pound man. 300-pound man is like charging at the woman, but if she knows judo, she can use all of his momentum against him. And so even though she's 200 pounds less, she can use his force against him, you know, by flipping him, kind of thing, stepping aside and flipping him. Same idea. In this instance, you have something more like this, where you use all of that downforce as a slingshot to the upside. And there's also going to be the potential that something will say strong thrust. So this is a qualifier in front of thrust. This will happen when a signal fires that triggers 2 or more arrows at the same time. So I've coded the high-low to have minimal arrows at this point in terms of well, it should just have minimal arrows. But when you see the strong thrust, that means that it went through two zones. So let's imagine it this way. Imagine that there's a level here that would trigger an arrow, and the line is coming up like this, right? And if the line crosses that level, whatever it is, it'll trigger an arrow on the chart. Let's say that there's another level here directly above, and that would also trigger an arrow up. And something happens where price goes up and it triggers through both lines. Okay? So in that instance, it might look like this. Now, it won't look like this anymore because I coded it out. But what it would look like in the previous version would look like two arrows on top of that bar, or below the bar, I should say, indicating that it double triggered high-low. Okay? You will never see the double arrows because I coded them out. But what the replacement for that is cleaner, and it's just the strong label. So why do we want to know that? Because it usually happens on initial breakouts. So if you're going to have like, let's say that you have a kind of a chart that kind of looks like this, and it's kind of basing down here, and there's a potential they could kind of reverse back to the upside, you'll often see strong thrust as a way to break out of base patterns. It's uncommon. You're going to see it in trends. You don't have to prioritize strong thrust. It happens under conditions that, like if you're a trend trader, there's a chance you might never see strong thrust, but it's not a big deal. But just be aware that if you're a base breakout trader, strong thrust is going to be your friend. Well, if we got strong thrust and we have slingshot thrust, why not both? Strong slingshot thrust. So you just combine everything. Prints strong asterisks when combined signal of both strong and slingshot conditions is simultaneously true. Best signal on high-low elite. So essentially this is the high-low elite playing all its cards at once. I showed you thrust, that's the arrow. I showed you slingshot, arrow up, then arrow down, or arrow up, down, then arrow up. And then I showed you strong, which is two or more arrows triggering on one bar. It's possible all of these three things happen at once on one bar. If it does, what you will see is strong thrust and an asterisk. Here's the thing. Do you really need to concern yourself with a lot of this? The truth is you really don't. Just understand that when you see it, it is a little bit of a stronger signal. So that's basically it. It's just a little bit stronger, right? Thrust is strong. Thrust is a signal. Slingshot thrust is a slightly stronger version of it, and strong thrust is a slightly stronger version of that. And strong slingshot thrust, both of the last ones combined, is the strongest iteration of that signal. But at the end of the day, they're all the same signal. So there's also the potential for extreme to show up on the high-low elite. And this is actually even more rare sometimes than true momentum. And I pay a lot more attention to this one than I do true momentum. See if you can guess why an extreme reading, and let's just colloquially say overbought and oversold, just so that we understand each other, although I don't necessarily mean those terms. Why would an extreme reading on an oscillator matter more than it does on true momentum? Throw it in the chat. I'm actually looking at chat right now. Why would an extreme label or a reading matter more on an oscillator than on the trending indicator? Looks like a few of you are getting it. So the reason that the extreme label matters more on the oscillator is because it's an oscillator. It's designed to do that, right? And so it's extremely rare that the oscillator does not oscillate to a sufficient enough degree that it actually creates an extreme reading. So this one I do pay attention to a lot more. This one is unsustainable. Just a heads up on that. The extreme reading on true momentum, I view that as a good thing. On high-low, I view it as a good thing too, but it is a huge warning that I need to be tracking it to ensure that it's a good thing. So the extreme label prints extreme if the secondary oscillator line is above or below 80. You'll never see the second line unless you choose to enable it, which I highly recommend you don't. When that secondary line gets to 80 or 20, the extreme label reads on or lights up. It's a rare condition. It's too hot or too cold. That can be okay or a good thing, but I would highly, highly recommend that if you're in this condition, that you have very tight stops. In the event that you want to show the hidden oscillator line, what you do is follow these steps. I do not recommend it. But if you want to play around with the idea, this is how you do it. It doesn't need much more explanation. I will repeat, I do not recommend it. You won't break anything. I just don't recommend it. It's not necessary. I've coded everything it does for you. You don't need to see it. But in case, you really want to look under that kimono, some of you do. So this is a new one, and this is a throwback to my Apple days. So back in the day when there was a support document on Apple, and it's something along the lines of like, how Windows has like the system32 file or the folder that if you trash it, it like ruins the whole computer. Well, there's a similar folder on Apple, and the support document for that folder says that avoid this folder like you would a box of bees. So I decided to pay homage to my Apple days by calling this one the box of bees setup. So you see down there where the high-low is. You see how messy that is? You might look at that and say, that's a useless indicator. In reality, it's actually giving you a signal. It's a box of bees. Don't just avoid it. Wait or avoid it. So the arrows up or down in a row indicates total indecision, right? The indicator is actually always giving you a signal. It's just most of the time it's going to tell you to avoid things. It's a filter, not a signal in most cases. Which actually that is a little bit of gold that I just dropped on you. It's a filter, not a signal, in most cases. Avoid congested situations like this. Watch and participate later once the signals become consistent. In general, avoid the box of bees. If you're familiar with high compression squeezes, it's kind of the same idea. Basically, it's saying it's so tight and so dangerous that there's nothing to do inside of this pattern until the pattern resolves. The box of bees. Lastly, do not be an arrow monkey. Everyone likes this slide. Don't be an arrow monkey. It's natural to see the arrows as a blind buy or sell strategy, but it is not that. Remember to use all the indicators together, and frankly, now they're all tied together, so it's automatic, to have the best understanding of what's going on. Once you have determined the high-low is the one to follow, then use the arrows as part of the information to make the next decision. Remember that when true momentum looks ideal, high-low down arrows are typically only mean reversions to the moving averages. So that's the takeaway from that slide is the last sentence, or the last sentence. Remember that when true momentum looks ideal, if you have a down signal on high-low in an ideal up trend on true momentum, chances are that's just setting up a pullback buy to the moving averages, not a reversal. Part 6, the score. So I forgot to update this one, so you don't really need it, but I should probably delete that slide actually. I'll delete it before I send it out. I was going to put something there and I never went back and filled it in. Changing the style. So we talked about this in the indicator install session. Again, very basic stuff. If you want to change the style of it, make this your own. The only thing that you are not allowed to change without breaking something is this. Those 3 numbers. Don't change those. But if you want to change the colors, this will globally change all of your colors, your candles, and your labels, I believe. If you want to change the buy or sell, by default, out of the box, it says buy or sell. A lot of you have sent me screenshots, and many of you have changed that to B or S or the arrows. Completely stylistically your decision to make. And then, of course, if you, for whatever reason, don't want to see any of that, you have the option to disable that as well. So we're going to get nerdy here. This might be too nerdy, but here we go. This is the part where I'm going to tell you, you don't need to know this. And I actually really considered making a very big deal about this and actually saying that unless you are someone who is obsessed with details, and I truly mean obsessed, almost to the point of neurosis with details, and I don't imagine that applies to more than maybe 10% of you. Unfortunately, I'm in that 10%. I don't imagine it applies to more than 10% of you statistically based on the fact that I've, just the aggregation of humanity that I've met. This doesn't apply to more than 10% of them. I would actually not pay attention. Okay. Now, I understand that as I tell you that I'm about to give you forbidden knowledge, that each and every one of you will perk up even more. None of you will say, okay, he's about to give us forbidden knowledge. Let's just not pay attention. But what I will tell you, and it'll make sense later, you don't need to know this. In fact, you're probably paying more attention now than you have before because I just told you it's forbidden. But loosely, just kind of keep it in the back of your mind that this is not necessarily things you need to know. Let's take a look. I'm going to show you how everything is calculated, right? I told you I was going to lift the kimono for you, and I forgot to wear boxers, so enjoy the show. EMA calculations. So there's a lot of inputs into the score, right? I told you there's a sophistication level to it. I'm going to show you why. EMA calculations. If you are interested in how the EMAs are calculated, and I'll repeat one more time, every single one of these slides will have this little disclaimer because I'm going to keep saying it. You don't need to know this. This is not going to make you better. Your goal, most of you are here to make money. You're not here to be a nerd when it comes to indicators, right? You bought this class because you want to make money. You want edge. The indicator is going to give you edge. So I'm being a little bit firm here because I just want to be sure that this is understood. You do not need to know this. It's all coded in. This is for the 3 SAMs out there. So these are the point value EMAs for everything. The 4 moving averages that I use are calculated in. So it's the 10, the 20, the 50, and the 200. If the 10's above the 20, that gives points. If the 10's above the 50, that gives points. If the 20's above the 50, that gives points. And then if there's enough bars for a 200, if the 50's above the 200, that gives points. Each one of these 4 things is an input. These are the inputs that it gives. These are the totals that those inputs could possibly reach. If you have all inputs, you will get a 10. That results in 35 points attributed to the score. Anything that is less than a perfect 10 gets less points. 7 out of 10 gets 30. 5 out of 10 gets 20. 3 out of 10 gets 10, and 1 gets 5. There's a bearish side that got cut off. You don't need to see that it's completely mirrored. If you are interested in this logic, and again, I would repeat, this is if your eyes glazed over, they should. Okay, this is not the important part. This is just the section for the Sams that came to see what's under the kimono. You dirty dogs. I told you I was going to lift it and you still showed up. What's wrong with you? More inputs, trailing ATR stops. So these are the point values for the trailing ATR stop. If it's above the trailing ATR, the score will be +5. If it is below the trailing ATR, the score will be -5. +5, -5, just depends on the label. All of this is coded into the score. The MACD, if you're interested in the values, I use a very slow MACD. It is a very small input into my system. It is only 5%, but I thought enough of it to keep it. I use a very slow MACD. None of you would ever use these settings. I don't recommend them, but it is good for this system as a 5% cherry on top. If it's on the right side of the MACD, it gives, it's not listed here, but it gives 5 points. Okay, so now this is the big one. This is the real big one. So now we're going to talk about the spreads, and then in a later section, I'm going to tell you everything that you do need to know, because there's a very important thing that's coming up here in just a few minutes. So how many of you are looking at this chunk of code on the right-hand side and your eyes are glazed over? It's okay. One of you can, one of you can say like, what is going on here? What are we doing? And that's fair. And I would honestly, in most cases, agree with you if this wasn't my indicator and I didn't write all this. Okay, so this is for the real nerds out there. You don't need to know this for the 100th time. I'll keep repeating it because it's true. Here's how the true momentum assigns points. So if this is called a bullish override or a bearish override, this happens if the spread between both lines is 10 points or higher. Then it actually gives an additional bonus. So if the spread between fast and slow is 10, that's a horrible line. If it's 10 points, you get 10 points extra. If the spread is between 65 and 65, both lines above 65, and the spread is basically, if as long as one is above the other, the spread is zero point 0.1, then you get an additional 15 points. I won't go through this word for word. Here's the thing: if you're a real Sam, you're really neurotic about this. You don't need me to explain this. So I'm gonna take care of everybody else, including myself, and actually not explain this and explain it in a way that everybody could benefit from. If you're a real nerd, dive to this on your own and email me, and you and I can have a personal nerdy conversation. But as I'm going through this, I'm thinking to myself, I really should explain this in a more digestible way. Let's do that instead. If you're a real nerd, just email me. We can geek out. So here's the deal. If the fast line is above the slow line, it gets points. If the fast line is above the slow line and they're both above 50, it gets more points. Okay? There has to be a certain distance between the lines to attribute points. If that distance is too small, let's say the fast is here and the slow is here, and this distance is tiny, it will not give points. Okay, so you get the most amount of points if both, I'll use the bullish side and just in your mind mirror it to the bear. You'll get the most amount of points if you're on the bullish side if both lines are above 50, the fast is above the slow, and there's a good spread between both lines. Then at that point, you're hitting all the points. There are conditions where the fast line will be above 50 and the slow line will be below 50. That is accounted for. That results in less points. If in this condition the spread between both lines is, let's say, 9, you do not get bonus points. You just get standard points for being fast above slow, but not as much points as if they were both above 50. If the spread goes from 9 to 10, bear with me, I gotta clear my throat. If the spread between the lines, so let's say that this number is 60 and the other, the slow one is 51. Okay, that difference is 9. You do not get bonus points. If the fast one goes to 62 and then the slow one is 51, how much is the difference? 62 minus 51. It's 11. It's greater than 10, you'll get bonus points. Okay? So that's the general gist of it. I just wanted to include all of this, again, in the interest of showing you how it all works. Now, let me front run myself here just a little bit. Do I talk about this? Okay, yeah, we're going to finish. So keep this in mind, and then we're going to round back to this in just a second. So how is the total score calculated? So the total score is going to be plus or minus 100. The trend inputs, which are the moving averages and the trailing ATR inputs, are 40% of that total. Momentum, which is everything else, true momentum, high-low, and MACD, is 60% of the total. Trend is calculated by EMA structure plus ATR position, and momentum is calculated by true momentum position, which is 40% of that total, high-low, which is 20%, and MACD, which is 5%. total score levels. So these are the values for the total scores. And notice my little asterisk here, I changed it. Before, I was doing that because you didn't need to know all that nerdy stuff. And in fact, I would actually highly encourage you to let your brain forget that. Keep your brain nice and mushy for me for later so that we can sculpt it into an indicator machine and not, a nerd box. You definitely want to know this one. And just because it's very simple. Where are the values where things trigger? If it's 100 points, it's max bull. If it's 75 or higher, it's bull. If it's 45 but less than 75, it'll be neutrally positive. You'll get a blue neutral label. Anything between 44 and negative 34 will be completely neutral. Okay? And then everything I just said on the bear side is flipped. So and really, here's really the only two numbers you really need to know. 100 and 75. At 75 is where it triggers bull. At 100 is where it triggers max bull. Just keep it simple. And then put a minus sign in front for the bear side. Let's talk about the buy bubbles. So now I just showed you how it all is constructed. That was how the sausage is made, essentially. So let's enjoy some sausage. Although I don't actually like sausage. How trends trigger buys. So this is where it starts getting important because this is relatable and easy to understand. You don't need to know how the sausage is made. Let's just slice it up here. So where will trend buys trigger? So trend buys will trigger. They will trigger on different levels depending on the score. So if your score is 95 or higher, and I'm just giving you the bullish side in your mind, it's just inverted for bear. 95, negative 95. If the score is 95 or higher, then a buy signal will trigger near the daily 10. If the score is 94 to 75, then the buy level drops down and it will not automatically trigger until the 20 EMA. Now here's kind of the cool part. There's a band around these, right? Meaning that it doesn't actually to the penny have to hit it, right? Trading is it's a game of grenades, not horseshoes, right? You kind of just want to get in the zone. And that's why earlier when I told you guys that if you wanted to use the daily 8, you absolutely could. Because think of the moving average as kind of having like this little halo around it, and it'll trigger anywhere in there. Okay? This is a little bit too nerdy. You don't need to know this, but just so you're aware. Scores 95 or higher. Where do those trigger? Here's your test. Don't put it in the chat. I'm testing you mentally right now. If the score is 95 or higher, where does it trigger? Around the daily 10. If it's 75 to 94, the score, 75 to 94, where does it trigger? Near the daily 20. That's it. That's everything. Everything else is just extra. The 10 has a halo of 0.33 ATR around it. You don't need to know that, but just be aware. The 20 has a 0.45 halo around it. Here's the reversal logic. So you don't need to know this either, but again, I promised I would make it as complete as I could, and this is everything. So reversal logic. What would trigger this reversal here? Well, primarily it's let me backstep for a second. Let's start with this. Notice how Microsoft had nothing but trend sells all through there, right? So what is it doing? Well, Microsoft was a bearish chart. Notice the bars aren't dark red; they're like light red. And so notice how it keeps banging these cells every time it hits the bottom of the cloud or the 20 EMA, right? Bang, bang, bang. It's just triggering cells. Here it seems to go into even more of a downtrend where it starts triggering at the 10, right? Okay. These are all, this is like the easy one, right? Like and these frankly, the red ones and the green ones are the ones that you should primarily focus on. The white ones will require more work, and this is why I'm going to spend some time on them. The red and the green are very straightforward, and those are the ones you should focus on. They're going to give you the highest probability edge. Those have the most historical backing in terms of how they will probabilistically play out. So I'll say it one more time. The red and the green ones are your best friends. The white ones, however, are important to understand because they'll trigger under specific conditions. Primarily, the white ones will trigger if a change in the score is large. Let me put it that way. So something happened here in Microsoft where the red bars changed to gray in such a rapid way. And if you are interested in the math, although you do not have to know it, if you're interested in the math, that's what it looks like. Where the change happened so fast that it went from red to gray, and it triggers that buy. Right? It's a reversal buy. So that's the logic behind that. And of course, everything that we just talked about on the bear side or the bull side, this is just the inverted slide. So I don't need to cover it again. Everything is exactly the same. Just stand on your head. It'll look the same. And exactly the same thing here, right? We just covered the reversal logic. Let me just think for a second if I'm missing something here. No, everything's about right. All right. Okay, the next slide is really what's important here. Alrighty, so the true momentum higher time frame things to know. This is an important one, guys, and here's why it's important. The true momentum works on a higher time frame, right? The reason that it works so well is because it's actually looking at data from a higher time frame, which creates a smoother, in my opinion, more reliable data set with a lot less noise. That sounds great, right? Doesn't that sound great? Like if somebody could tell you, hey, person, I'm going to take that indicator you use, I'm going to remove a bunch of the data, I'm going to remove a bunch of the noise, and I'm going to make the signals that it generates significantly better. Would anyone ever say no to that? Well, here's the thing. Doing the higher time frame data pool, essentially, it will accomplish that. But in trading, much like in everything in life, there is a trade-off. And the trade-off is that it requires the higher time frame to close before it locks. So, for example, the high-low doesn't have this dynamic. The high-low is just running on the chart that it's running on. So if you have a 1-minute chart of the high-low and a 1-minute bar closes, that's the signal. 5-minute bar closes, that's the signal. High-low is running on a 5-minute chart, you'll get 5-minute data. With true momentum, these are all the different time frames, and these are all the different periods that it's actually referencing. Okay, so I'm going to spend some time on this one because it's important. You don't need to know this much. Like, I wouldn't print this out or memorize it or anything like that, but I would be aware of it. And the concept here is really important because this is going to affect everything, right? The reason it affects everything is because the biggest input into your score is the true momentum. So it's important to understand. So the daily chart, if you pull up a daily chart, the data you see is actually the weekly data. If you pull up an hourly chart with true momentum, the data that you're seeing is actually daily data. The 5-minute is actually 30-minute data, right? Okay, so the idea of creating an indicator that has a lot less noise and that makes the signals reliable, a lot more reliable, that sounds pretty good. What's the trade-off? Well, the trade-off is that now you have to wait for the bars to close in order to confirm the signal, right? There's always a trade-off in trading. So what does this mean? Well, this means that if you get a 5-minute signal, it's not technically considered locked in place until the 30-minute bar closes. So that means that you'll have a 6-bar window, if you think about a 5-minute chart, you then have to look at it this way instead. Instead of saying that's a 5-minute bar, that's a 5-minute bar, that's a 5-minute bar, you then have to look at them in chunks of time. Okay, so I'm trying to think if I should pause here for a second and ask if there's questions. Okay. Let me just think for another moment here, because this one's important. I don't want to miss anything. If you want to save that photo and kind of have it somewhere, it wouldn't be a bad idea. Eventually, you'll use it so much that it'll start to be like second nature. But it is pretty important to understand. So why is it important to understand? Here's why it's really important to understand. Because of the higher time frame, it is possible that retroactively the signal could disappear or appear. And it happens in both ways, right? So it's this interesting thing where it is possible, and it happens a lot more on small time frames, right? So if some of you have been trading on like a 1-minute chart, chances are you're going to see that there are signals that will potentially reprint in certain scenarios. Now, those scenarios are very limited, but it is possible. So why is that? Because if you're looking at a 1-minute signal, it's not actually considered locked until the 10-minute bar closes. So let me give you an example of what that could do. So let's say that you have, let's say this. Let's say you have a chart that's trending up, right? And let's say that it's like buy, right? It's just green buys, very happy-go-lucky, and then it's going up, and then let's say maybe they have earnings, and earnings is on a Friday, okay? So then Monday, it maybe goes sideways. Tuesday, it goes sideways. Wednesday, it goes sideways. Thursday goes sideways, right? And you have all these buys leading up to it. Then on Friday, you have earnings. Let's say it's before the market opens, and the stock tanks, right? There is because of the fact that the daily is looking at the weekly, right? Keep in mind this was Monday, and now this is Friday. This is a window of time. If on Friday the stock crashes after earnings, it will print a sell signal on Monday. Okay? Maybe I can give you a live example. There's one example that I can think of. So SanDisk. This is actually a perfect example. This is actually, yeah, they say a picture's worth 1,000 words. This is a perfect example. Good job, Sam. Your memorization of charts is unnecessarily good. So this is a good example. I literally just drew this example for you, and then I had this one in my back pocket the whole time. SanDisk. This sell signal on SanDisk looks pretty damn good, doesn't it? Like, whoa, it nailed the top. How did it do that? 1 bar, 2 bar, 3 bar, 4 bar, 5 bar. The sell signal on SanDisk did not actually happen until this bar here, right? Keep in mind, 5-bar window. So did SanDisk have an actual reversal sell signal on this day? I'm not entirely sure, but I would almost guess absolutely not. I think the sell signal triggered on that signal here on this bar. Okay? So because it's within the 5-bar window and the weekly bar is not considered closed until this bar, the Friday bar, then the signal will retroactively print at the start of that week. So even though you did not get a sell signal until this bar is the one that shows the signal. Okay? Now, that is significantly much more of an issue when it comes to reversal signals. The trend continuation signals will not exhibit this behavior almost almost at all. Okay. Yeah, yeah. So this is a big one here. So it's important to understand it. I actually don't find it to be that big of of an issue, right? And frankly, as I'm kind of going through this, I've been in the back of my mind thinking of how I could possibly address this issue in an elegant way that keeps the structural integrity of all the signals. And I don't have an answer for you yet. And frankly, I might not have an answer because the answer is to stop referencing a higher time frame. The thing is, if I stop referencing a higher time frame, the whole thing breaks. It just isn't good, right? That's what everybody else is doing. There's very few people that are using the higher time frame analysis like this, and it works. But there is a catch. So I'm spending a little bit more time, and the SanDisk example is a perfect example. So let me just say it one more time. Right now, this looks like it just absolutely nailed the top there on SanDisk. That signal was not in place until this bar right here. How do I know? Because, and you should be able to do this too as well. Let's actually, we'll spend some time on this. Remind me of this, that I want to go through a couple of charts with you guys so that you can tell me where they're losing or gaining points. But SanDisk lost its points right here where the lines collapsed, and then it lost a ton of points here on the arrow. So this was actually the sell signal there. Granted, that one's working too, but because it's in a 5-bar window, it will retroactively apply it to that signal. I'm going really slow on this one because I'm making sure that you understand, and then two, I'm kind of thinking out loud how I could do this. I'll probably be able to fix this at some point, but it's going to take a lot of subconscious processing. So we'll go ahead and move on, but that one is an important thing to know, and it is much more likely to happen on reversal bars because of the very nature of shifting colors. So you won't see it happen on green or red bars almost that often at all, but you'll see it happen on white bars sometimes. So be important of that. And we'll cover this. We'll come back to this in a lot more detail once we get to the chart review. We are coming up on another hour here, and even though I don't need breaks, maybe we can take a break after this one. Yeah, this is perfect. So we'll take a break after this slide. I'll let you digest all this. So the miscellaneous thoughts on the buys or sells, and we really just covered all of that with that example. Candle close is key. Review true momentum repainting scenarios. That was a note for myself, which we just did. And it happens in both scenarios, or both directions. So sometimes the repainting makes the indicator look better, and then sometimes the repainting makes the indicator look worse. So I just kind of put them together in a washing machine and say it's a wash. And then sometimes it happens exactly as it should. And most of the time it'll happen on white bars. So we're going to cover this in a lot more detail so that you can understand these moments in time. They are not that common for what I do, but we'll cover this in a lot more detail. And this is kind of why I said this as well, right? Like it is an automatic system in the same way that planes mostly are flying themselves nowadays. But last time that you got on a commercial airplane, chances are they had two pilots, even though the plane could fly itself. So I'm giving you the autopilot, but I'm also very much encouraging you to deeply become your own pilot and be able to navigate that. The plane will fly itself. You just need to be there for those moments in time where, there's a gap in the plane logic. This is important. Green or red bubbles don't require more confirmation, meaning that you can just buy green or red bubbles if you choose to. However, that's not how I'm teaching it in the class. How I'm teaching it in the class is that you want to use a lower time frame confirmation that allows for better precision and edge at the low cost of paying slightly more. Somebody write this down. We're going to go back to this example, IWM daily. This will be a perfect example for this dynamic because it has a buy signal since Friday, but it does not have an internal reversal signal on an hourly chart. If that doesn't make sense, we'll review it live. And this is a point towards the repainting. So if you're trading 1 minute charts, 1 2 minute charts, 3 minute charts, especially 1 and 2s and 3s, anything under 5, frankly, anything under 15 minutes, be very aware. If you're trading under 15-minute charts, you are playing the stock game on expert mode. And this is a question only you can answer, but this is a very direct question. Have you earned the right to do that? We're going to talk about that later. If you're trading a 2-minute chart and you're just losing your ass nonstop, you have not earned the right to do that. Okay? In the same way that many of you have kids, and many of you probably have kids that are around the age where they start driving. The ideal car for a kid to drive in is probably like a Honda Accord. Right? Now, if you ask your kid, they probably would say, yeah, get me a Ferrari. Right? But the same question would be asked. Have you earned the right to do that? In the same way that your kid hasn't earned the right to drive a Ferrari as their first car to get their license, have you earned the right to trade under 15-minute chart? And only you can answer that question. And what does it mean? It means your P&L reflects it. If you're just getting your ass handed to you on a 1-minute chart every single day, you have not earned the right to do that. And one more point, be really honest with yourself. It's not a judgment. It doesn't mean that you're a bad trader. It doesn't mean that you're dumb. It doesn't mean that your parents should have hugged you more, right? All of those insecurities that trading can bring up, it doesn't mean any of that. It just means you don't have the data to support the action that you're taking. Take another action, come back and take the test again. Always spin it in a positive way, but I wanted to be a little bit harsh on that one because I see a lot of folks trying to do expert mode things and they haven't earned the right to do it. So I just wanted to take a moment to talk about it. So once we come back, that was the full indicator part. We're going to kind of really start running here, right? So this was the indicator heavy lifting. This was me teaching you to fly the plane, essentially, on your own. So there's 2 parts. The plane will fly itself, but I want you in the cockpit awake, not on your iPad, so that you can adjust the plane as necessary as it automatically does what it does. That was the previous section. That's why we spend so much time on that. And any question that you have, just keep them in your back pocket. We're going to get to those in the Q&A. The next part that we have, these are going to be, we're just going to blow past this next part. And what I mean by blow past is we're going to go really fast. But what I want us all to do now is get to the reps, right? We just read the book on how to play golf, mixing metaphors. We just read the How to Swing the Golf Club book. I think it's time that we go out there and go to the driving range and go to the practice our putting, bust out our irons, and start putting some of this to work. So, does that sound exciting to you guys? We're going to start putting this to work pretty soon. Look alive, guys. That sounds exciting to you? Let's start putting this to work, right? We just learned how to do everything. Let's start swinging the golf club here pretty soon. I think you're going to enjoy this next section. We're going to go fast, but this is there's going to be a human element here, and there's going to be a lot of heavy focus on psychology coming up. And then once we get that fun stuff out of the way, and it is fun. It truly is fun, actually. I love talking about psychology. I can teach you the indicator stuff. I just taught you the indicator stuff in 2 hours, right? Well, the part that's really cool is that the psychology element is something that you get to work on forever, right? There's no manual for being a human. So we're going to cover that. That's my idea of fun. But let's maybe take 10 minutes first. Let's meet back here at 3:35. 3:35. And if there's a way that a mod could put up a timer or something, because I can't put it on my own. But let's meet back here at 3:35, and we'll carry on. Welcome back from break. I had to use Thriller, one of these songs, right? The best song on that album is Billie Jean. But we had to use the namesake. So the next part is going to be some trading things that we're going to touch on, but we're not going to do super deep dives because there's just not enough time, and this is an indicator focused class. But I do want to touch on this stuff because what I want to do is just put it in your bucket, and then for those of you that are interested in these things, you then can go and expand on that on your own. So an example would be like Fibonacci, right? Am I going to teach you everything I know about Fibonacci from the top down? There's not enough time. But if you're not aware of Fibonacci, I'll lead you into it, and then that'll create a branch for you to explore. Same thing here with multi-time frame analysis. So for this next part, be aware that we're just going to touch on some of the most important things that I have found in trading that are outside of the indicators. We're going to then touch on psychology, which is a huge one that I will spend some time on. And then we're going to dive into the charts. So price cycles. So this is the idea of using multiple price cycles. Essentially, everything's kind of rolling in this rhythm, right? Everything's a series of waves if we want to get really abstract. And you have the big waves, right? The big trends, and then inside of that you'll have the little trends. And then inside of those, you'll have even smaller trends. So you'll have a big monthly trend, and then you'll have weekly trends that ebb and flow inside that larger context. And inside of the weekly trends, you'll have daily trends, right? And you can go as down the rabbit hole as you wish, but this is essentially what they look like. So just an example of multiple time frame analysis. We're going to cover this maybe a little bit more in the chart work. I'm going to make a note here to review IWM because that was one that came up. At least on my end on the Friday video. So you can always just look one time frame down is basically the point of this. So if you're a weekly trader, you can use the daily to guide yourself. If you are a day trader, maybe you can use the 15 and the 5. Or if you're a really experienced day trader, maybe you can use the 5 and the 1. Prioritize longer term over shorter term, but understand that short term changes first. So short term will shift, then that'll shift the longer term. Multiple time frame analysis is an entire class unto itself, so we won't be able to go into much detail, but I do want to touch on it, and we'll actually touch on it a lot more with practical examples once we get to the charts. So this is what my weekend setup looks like. On the left monitor, you can see I have quarterly, monthly, 3-day, 2-day. The center monitor is weekly, daily, and so on and so on. So I like to, cover my bases. You don't need to do this much stuff. Again, I'm kind of an extreme version of everything, but if you're if you're a day trader and you trade maybe a 5-minute, maybe use a higher time frame like a 15 to confirm, or a lower time frame for a trigger. That's basically the general idea here. Level, momentum, and trigger. So this one's important. This one is going to be important because this is where we start to tie in the indicators with actual trading strategy, right? So far we have a lot of scores and the buy and sell bubbles. We have the lower indicators, but we want to be able to turn that into executable trade ideas because that's the whole point. So always think in terms of LMT, level, momentum, and then trigger. Waiting for LMT to confirm a trade will often lead to much higher probability of success as you have multiple points of alignment in your favor. This requires patience, but the edge is worth it. So let's break all these down. What is L, or levels? So levels, think of these, you can use the word levels, but think of them also as just points of interest. So what are some examples of points of interest? Previous highs or lows, and you can use the swing level for that, right? So essentially the idea is, here's basically the idea. You want to take action at a level that if you're wrong here. What you don't want to do is have a level here, you're buying here, and your decision to get out is here. The distance matters. Here you buy here at the level and you're wrong below the level. Here you're buying way above the level and you're still wrong below the level, just the distance is large. So this slide is essentially what levels to use. And then the next slides will be how to take action at those specific levels. So you can use the swing levels indicator, very good for that. You can use the short-term moving averages, which is the 10 and the 20, as support or resistance, but only in trends. You can use long-term moving averages, but be aware that those are going to be neutral to weak trends. You can use a VWAP or an anchored VWAP. This is something that if you're not using on your charts, I definitely recommend. We won't be getting into it deeply into this class, but essentially just it's built into TOS, it's built into TradingView. The easy way to do it is just to anchor it to the beginning of the year. Very lightweight and highly beneficial. And it is an example of a very strong level that you can look to take action based on momentum and triggers, which we'll cover next. You can also use major Fibonacci confluence zones, extensions or retracements, 618s, and then you can also use voodoo lines, trailing ATR, quant pivots, spot gamma, etc. as levels. Okay, so there's a lot of different levels in the market. It's up to you to decide what is relevant, but the number one thing that you're going to be looking for is a level so that you have a wall to put your back against. And if you're wrong on the trade, then you're wrong always small because you, you placed yourself next to a level, and then you can take action from there. So M is going to be the LMT, right? So level, momentum, trigger. What are some examples of momentum shifts? So a high-low thrust arrow in a neutral market would be one. True momentum crossovers, so the fast would go through the slow, would be another. Divergences on true momentum, EMA crossovers on lower time frames. Let's focus just on the first two. So here's what it ends up looking like. I'm going to start sketching everything out. So level, we know, right? Let's just use kind of a basic one where you kind of have a chart like this, right? And that's your level, right? Easy W-shaped pattern with a level right there. Okay, so where would your stop be? Probably right here, right? That's probably where everybody's putting their stop. Be aware that everybody's putting their stop there, but for good reason. Okay, so let's say you bought at the level, right? Or you're making a decision. Price went down, it's up, it's down, it's at the level. Okay. Level. Take it's like a sprint by yourself. This is something that you have to do when the candles are but you see my candles. It's not so if you're planning to do something right, then this is the so longer. This data here. What would an example of a momentum shift at the level look like? Well, you would get down to the level, and then you'd print an arrow on the high-low, at some point here. Okay, well, then that would give you your momentum. The last bit is the trigger. The trigger can be done in any number of ways. There's an infinite number of triggers you can use. Breaking the high of the low bar would be one. Moving average crossover would be another. Using a smaller time frame to confirm that the candles have changed colors. So let's say, for example, in this example, this is a 5-minute chart, right? We have our level, check. We have our high-low arrow, that's our momentum, check. What can we do? Well, we could drop down to a 1 minute. I probably shouldn't use this example. Let me make a 15 and a 5. I don't want to encourage a lot of 1-minute action out there. Let's say it's 15 and 5. We can then switch to a 5-minute chart, right? And see if the candles have shifted colors. You can switch to a 5-minute chart and see if it's made a higher high or a higher low. There's a lot of different triggers. I don't have time. I'll show you some here in just the next slide. But this is essentially what it ends up looking like. You want to get to a level, you want to have a momentum shift, and then we're going to look for a trigger. And I'm going to give you an example of that in the next slide. So examples of triggers: closing above or below a swing level or any point of interest. A high-low thrust signal in the direction of the trend. Closing above the high of the low bar. Closing below the low of the high bar for bears. or a moving average crossover, usually on a smaller time frame, right? There's many, many triggers you can consider, but these are some of the most common ones. The main takeaway from this is really make it your own, because I gave you an example of many different levels. Now you're going to have way less momentum changes because I've given you your momentum indicators, and those are going to be either arrows or bar color changes, right? So those are somewhat limited. And then you have any of these triggers, or you can make up your own, right? But really the takeaway here is think in terms of, do I have a level? Do I have the right momentum? Check, check. Last check. Do I have an internal trigger? If you have all three things, you could take the trade. So basics of Fibonacci. So again, very basic stuff here. Just running highs to lows, looking for 618s, looking for the 1618 extensions, 1272s, right? You guys are all familiar. Most of you are going to be familiar with this. I show you this not as a part of the class necessarily, but just as something for the folks that maybe aren't familiar with this stuff to say, hey, that might be something I want to learn more about, and then they can go learn more about it. So just a basic Fibonacci retracement. Here's some basic Fibonacci symmetry, right? So 1 is the most weighted level, just basic stuff here. Again, just to whet your beak, not necessarily part of the class. More Fibonacci symmetry. And this is going to be most helpful for the folks that are like, what's Fibonacci symmetry? Oh, that looks kind of interesting. Let me go read, Fibonacci Queen's book, which is a pretty fast read. I read it on a flight to Chicago. So Fibonacci miscellaneous to know. The most important level is going to be the 618 or the 382. Same idea, just inverted. Fibonacci is projected support or resistance, which I view as secondary structure between highs or lows. So I personally do not view Fibonacci on the same level as I do horizontal support or resistance levels from previous highs or lows. If you're grading out your levels, right, from like A tier to B tier to C tier, A tier is horizontal support or resistance. Just because I'm viewing it as lower quality than that, Fibonacci would be B tier or C tier. So be aware of that. Price targets and stops. So there's lots of different ways that you can find profit targets. One easy way is previous swing highs or lows, just taking your profit back at the the double top, the double bottom zone. Doesn't mean it's a double top, but you could take profits at that zone. Fibonacci extensions or retracements would be one, especially with the current market, we're trading at all-time highs. If you look to the left side of the chart on something like the QQQ, there's nothing there. So there's nothing to reach for as a target. So you would just use Fibonacci for that. Any other type of support or resistance, like a previous high or low or moving average. Okay, so just many different ways to do this. I'll say it again, just touching on this stuff intentionally, slightly superficially because of the time limitation. This is only intended to whet your beak if you're interested in any of this so that you can go ask more questions as to how this works. The focus is the indicators. So in terms of stops, the best stop is really to ask yourself, what was the reason you got into this trade? One thing that I think would be super helpful for all of you guys would be if you kind of, in your mind, pretended like you were on this end of the mic. In the same way that, we have to talk as traders on this end of the mic to 100 people of varying skill sets and experiences and life paths, and in our best way try to convey one singular message to this group of people that are very diverse. Ask yourself, could you do something like that? Like if all 100 of us in here were standing behind you as you trade and we're asking you questions, could you answer them? And if you can, then you're ahead of most people. So the best question to ask yourself is, why am I in this trade? Articulate it, write it down, say it out loud. Once you've done that, if any of those conditions have changed, the trade is no longer valid. If I got into a trade for 1, 2, or 3 reasons, and now one of those reasons is no longer true, well, I only have 2 out of 3. So, that's a 66%. Back in my day, that's a D. Modern grading, I think it's a B+, but not good enough. If any of the reasons that you got into the trade are no longer valid, in my opinion, that's the best way to take a stop. there are reasons that you're going to have to take an actual stop. Like, I need to take a stop below this number, especially if you're trading futures or something highly leveraged. But in general, I think that if you can start the trade by saying, these are the reasons I'm in this trade, and then as the trade progresses, always ask yourself, are these reasons still valid? If they are still valid, there's nothing to change. Even if price pulls back or goes up, if the reasons you got into the trade are still valid, don't change anything. If something changes, just one thing, and you're using that methodology, get out of the trade. Day trading FAQ. So day trading, what changes? People seem to have this idea of day trading as if it's this completely different universe, and I never really saw it that way. Even in my younger years, I just saw it as a faster version of what we do with swing trading, which in my opinion it very much is. So when day trading, we change nothing about our system except the time frame that we're anchoring and the time frame we are using to steer. We focus more on internals. We focus more on 0 DTE and weekly options. We focus on futures if the signals are directional. Just a couple random points. Don't let a losing intended day trade turn into an unintended swing trade. So if you ever find yourself buying like Friday calls for a move in NVIDIA and the move doesn't happen, and it's, let's say, Tuesday, and the move was supposed to happen on like a 15-minute chart and it didn't, don't then just say, well, this was supposed to be a 15-minute move, day trade. It didn't happen. I'll just keep my trade, right? The reason you got into the trade is no longer valid. Don't let that day trade turn into an unintended swing trade. LMT applies to day trading even more. You have to be very precise when you're day trading. There's a reason I always focus on this as saying that it's expert level stuff. Everyone wants to do it. Everyone likes fast money. I get it. But here's that sentence again from earlier, and there's a reason that I capitalize this, and I always try to focus on it, because you have to earn your speed. If you have not earned your speed and you're continuously doing the same thing over and over again, you're going to get not good results. The way to adjust is, if you're trying to day trade and you are doing it unsuccessfully, the best thing that you can do for yourself is to see if you can fill in the blank. If you're day trading or you're doing it unsuccessfully, the best thing that you can do for yourself is to increase your time frame. The lower the time frame, the lower the noise. The lower the time frame, the more difficult the chart. Go up a time frame. Work on that time frame. Prove to yourself that you can trade it. Once you've earned that, then you can drop time. Then you can drop to a lower time frame. This is the chart from earlier. I don't want to explain it all that much because I cover this all the time. I think it's self-explanatory. I wanted to include this here. I didn't know where to put it, so I put it in the day trading section because this is a pattern that happens all of the time nowadays. It used to happen maybe 2-3 times a week. Now it happens 2-3 times every hour, slightly exaggerating, 2 or 3 times a day. Be very aware of this pattern. It's the number one pattern I think you need to know. It's a very simple pattern. Study up on it. Let's move on to strategy selection. We're going to be covering option strategies here. This, again, is not the focus of the class. I just want to touch on all this stuff so that you can, again, get your beak wet, understand things that maybe you weren't aware of, and then you can branch out afterwards and maybe learn a little bit more about this stuff. So what are some trade strategies for alignment? So alignment basically means you have like a max bull or a bull chart and a squeeze. So for those situations, those are aggressive situations. Those situations warrant more aggression and more size. And the strategies for doing that would be buying calls or puts, typically delta 70. You can do at the money delta 50. Buying debit spreads, wide out of the money butterflies, I think work fine for that. Prioritizing high deltas is less important to maintain than maintaining positive theta. So what does that mean? It means that if you have a max bull chart and you have a squeeze, the focus should be on getting the most amount of deltas, meaning the most amount of directional input, than that, as opposed to theta. So meaning that if you have a very aggressive setup, max bull plus squeeze, go with calls or call debit spreads as opposed to put credit spreads. or butterflies, that are at the money or something. So what are some strategies for neutral alignment? So neutral alignment is when things are messy, essentially. And what are the strategies for this? So when things are messy, right, gray candles or green, gray, maybe a little bit of red and then gray again, right? You know those charts, those messy charts. Honestly, you probably should avoid them. But if you're inclined to trade them, then you would just trade them differently. And in this instance, you trade them with credit spreads, which is, the bread and butter of most people. You could do butterflies, iron condors, unbalanced butterflies, ratio spreads. In this instance, you don't want to prioritize delta, meaning direction. You want to prioritize theta, meaning time input. So you just shift it a little bit. Fortunately, the indicators basically tell you what to do. This slide is an old slide. This is back when we actually used to have it. In fact, I was a little sloppy on it because it is an old slide. I have the old name of the indicator here. But essentially the idea is the same. And what's great about this now is that all this stuff that used to apply to the old indicator, it's all built in. You don't have to actually do any of it. Really, the only thing you have to ask yourself, let's simplify this. Let's make it simple. Is it max bull plus squeeze? In that instance, calls and call debit spreads. Is it gray? In that instance, credit spreads, butterflies, condors, unbalanced butterflies, ratio spreads, with the understanding these are a bit more advanced. So my favorite strategies are these. I kind of already covered it, again, with the front running. It never ends. So we'll skip past this one because I already kind of covered it. I'll leave it up for a second. You can read it. All right. So position sizing for most accounts. So this is a very personal thing in terms of there's no right or wrong answer. There's good math that gets you to a generally right answer, and that's what I'm going to give you here. But I've seen John risk 25% of his account. I mean, I would imagine Henry's probably seen him risk more than that. But I know for sure that I've seen him risk 25% of his account, and that's also the trade that he's now most known for. Was what was it, like a $5 million Google trade? So even even the pros know when to break the rules. But here's the thing. The pros know when to break the rules. If you have not earned the right to do that, then you need to follow this strategy here. John has earned the right to break the rules, right? Most of us have not. So in general, common sizing that is appropriate for most accounts is about 2 to 5%, and 5 could be on the high end, so be aware of that. So 2, closer to 2, but up to 5% of NLV per trade. And the way you do this is actually very simple. Think of your account as units. So kind of going to a gambling mentality. If you have a $100,000 account, then one unit is $1,000. So you are allowed to risk 2 to 5 units per trade. And you just figure out what your unit is. It's usually 1% of your account. Now, there is a point here that I want to talk about, and this is just something that you're going to have to decide. I'll make my case, and then you can argue with me later. And that is, do you prefer to bet flat bets? Meaning you're going to sit down at the table, every setup that comes your way, you're betting 2%, 2%, 2%. Okay? That's one way to do it. The other way to do it is to scale your bets. And essentially you're saying, okay, this setup is better than this setup. They're both tradable. I'm going to bet 2% on this setup because let's say it's a 85% bull, and I'm going to bet 5% on the max bull, right? So you're betting 2% on the bull or the lower quality, yet still bullish setup, and you're betting 5% on the max bull, higher quality setup. Only you can decide what makes you comfortable there. I personally am a fan of the scaled bets because I have an understanding of how math works. So I've yet to be convinced that flat bets is the way to go just because I haven't seen massively successful traders that do that. The massively successful traders that I've known or have read about all do scaled bets. I don't want to influence you, however. Really, it comes down to what you do best. And I imagine there's traders out there that do flat bets that do just fine. You're up to your personality. The reason I'm spending some time on it is because I want you to think about it. I want you to think you'll land in one of these two categories. Are you a flat bet person? Every setup that is tradable, you're betting 1-2%. Or are you scaling your bets? And that's more of a John strategy where you say, okay, this is a stronger hand that I'm holding. I'm going to bet more than the previous. Pre-trade checklist. So index sector and stock. So be aware that, of this dynamic index sector and stock. Always look at the index first, then the sector, then the stock. It's just going to give you more edge. In total, this game, this trading game, it's all about stacking very, very tiny edges together, right? You might get maybe 0.5% of edge by doing this, but Vegas was built, all those really big buildings in Vegas were built with tiny edges stacked up over a long time. So that's your job as a trader, is to find these tiny edges. This one will give you a ton of edge, index sector and stock over time. So using the scanners. So I did a big thing yesterday on the scanner in the install session. So I do want to speed this section up a little bit. I also want to put this out there and let the chips fall where they may on this one. I'm not a fan of scans, or let me put it this way. I'm not someone that uses a lot of scans, right? I have this as my primary scan now. And again, just a collective shout of gratitude from the class to AJ, who put this together. So you will rarely see me looking at scans from now on, because this is beyond any scan that I could ever build. Look at this. Look at this. This is insane. Every major stock I could think of is here. Every score, dynamically updating. Every squeeze, updates every 5 minutes. Doing this on a scan would take me ages. Okay, so I tell you this because I'm about to go through the scans, but understand that I am not the. I'll say it straight up. I don't care about scans. So I'm doing this for you guys because some of you will care. But here's kind of the barbell. One, make sure that you have the latest max bull, the latest bull scan link. Mirza could drop it in the chat. I think your class folder's been updated with it. So what I am going to do is actually show you the one scan that I do run, that I do like. But let me say this: with the scan that comes with the class, the indicator, there's 2 scans that come with the class. You can build anything with that, but let's not go down the road of how do I build this and how do I build that and how do I build this and how do I build that, because that's an infinitely deep road. So again, I just want to say that because folks are the Pandora's box of scanning is infinitely deep, and I'm not going to open it. So that's kind of where I want to start with that. But I will touch it. I will cover it. So these are the 2 methods that I use for scanning. This is an updated scan that we published yesterday. So this will overwrite your bull scan. So this is the one that I'm going to show you here in just a second. I also did this yesterday, so you can catch that one, but I'll do it very quick. I want to make sure that we can get out of here at a reasonable time, and so I am trying to hurry this part because I personally do not find a ton of value on this element. This is going to be a lot of self-guided stuff on scans. Most of you will not be going through the process of scanning this deeply. And so I'm not all that concerned about it, but I want to spend more time on things that I think is higher value. So let's do this real quick. So there's that, and there's this. So for now, you guys have the manual score sheet. And I hope at least one of you filled it out. Did anyone fill it out? Has anyone filled out any of this coming into today? Yeah, you don't have to fill all of it out. So yeah, let's touch base on this. I'm just going to kind of like roll through this. So this is all basic stuff. I feel like I've over-explained a lot of stuff that I feel like maybe needed to be over-explained because it's like the really nerdy indicator stuff, and that's what the class is. This stuff is just hopefully very easy. So excuse me if I just go really fast. I'm going to assume you can type in numbers into a sheet. So I'm just going to blast through all of this. So let's start with this. This is something that I shared with you guys. The number one thing when you get this is super long, right? The number one thing that when you get this, make this your own. Okay. So the first thing that I would do is if I were someone that only cared about the top indexes. Let's say I only care about SPY and QQQ. I don't care about anything else. Boom. Okay, sectors. I only care about, let's just random. It doesn't really matter. Let's just say I just don't care about any of those. I'm deleting that. Let's say I don't care about any of these. Deleting that. Only you know what you care about. In terms of top stocks, same thing. The bonds and miscellaneous, really, in most cases, here's what I would keep if I were you, unless you're just a total geek like me. HYG, I would keep. AD JPY, AD Aussie yen, I would keep. Dollar, I would keep. And ZN, I would keep. VIX, I would keep. Everything else can go. Commodities, really, unless you care about gold, copper, or any of this, just don't even fill it out, right? I tell you this because if you have to look at this sheet and it's massive and it's overwhelming, guess what's going to happen? You're not going to do it. Or you're going to do it once and say, the next time you're going to say, oh, it's massive and overwhelming, I'm not going to do it. So make it your own, shrink it down, right? Once you've made it your own, then what I'd like for you to do is just go through and fill it out. Now, here's kind of the thing. Members, who's a lot smarter than me, he took the indicators and he automated it. So this is waiting in the wings, right? But in the same way that when you went to school and you complained to the teacher that, why do I have to learn math when I have a calculator? And they're like, well, what if you don't have your calculator? Learn the math. I highly encourage you to do this one time, at least, before we release this. At some point in the hopefully very near future, you will not ever have to do this again. So that should be that. Hopefully, that got a sigh of relief from one of you. And can we get some hearts in the chat for AJ? Seriously, this is amazing work, guys. Yeah, let's give a little bit of love here for AJ here. Yeah, thank you so much, man. This is incredible work because keep in mind, not only is it filled out automatically, it updates every 5 minutes. So as you're trading, boom, this thing's moving up, this thing's moving down, this thing has a squeeze. Fantastic work here. For now, this is what you have. Fill it out at least once, even though I teased you that this is coming later. Just do it once. Trust me on this process. Get this mind-body connection going with the indicators. It'll connect you to them. You'll start to understand them, and then once it's automatic, you won't. You'll be able to breathe a sigh of relief. So what do you do here? Really, it's very simple. Very, very simple. All we're doing is just typing in scores. So all you do is load up your charts. What score is the weekly? Let's just say it's 100. What score is the daily? Let's say it's 100. What score is the 4 hour? Let's say it's 50. What score is the hourly? Let's say it's negative 80. What score is the 30-minute? Let's say it's negative 50. That's your score, right? And that's what it ends up being like. And if you just make this your own and delete everything you don't want, it's very fast, and then two, it very, very quickly tells you where to focus. Okay. So I spend some time on this because the preparation is the thing that makes me ready to trade, right? I find that if I'm not totally prepared, and the preparation having happened beforehand, that the hesitation to get into a trade is higher. So the confidence matters, and this gives me confidence. So fill it out at least once or twice, and then hopefully we'll have this on the back end ready by the time that that fires. So that's that. I just want to touch on this one as well. So these are my weekly notes. I do try to share them in the room, in the Mastering the Trade room. I just want to show you what I look at. So I'm looking at Forex Factory / calendar. I'm making a list of the best stocks, right? And that's obviously being taken care of by the checklist. I got the CTA report. You don't need this, but I had Claude code this. I think it's pretty cool and pretty helpful. You don't need it. Here's me walking the walk. and filling this out the hard way, the grunt way, before AJ automated it. You don't need to be this deep, but I highly encourage you to spend some time on this after this class. If not, let's have fun after this class. Actually, don't even think about indicators after this class. Go have yourself a drink, enjoy your life. You guys have some beautiful lives. You have some beautiful spouses, some beautiful kids. Go spend some time with them after this class. But tomorrow morning, fill out that sheet. Give me 30 minutes of your time. Fill out that sheet, and it'll be worth it. But here's my sheet, and this is an old one. So just proving that I walk the walk. Twitter/eWhispers is where I get my earnings. I have the Trader's Almanac here, and I have seasonality. So for those of you that are going to be doing the live trading, I'll just give you my notes. For those of you in the Mastering the Trade Room, I just give you my notes. But if you're this nerdy, you can go through and do it yourself. Alrighty, so that was that one. Now, where were we? Where did my presentation go? There it is. Okay, so now we have to look at the scan. So I shared one scan with you, and it is really the only scan I really use is that one. But I want to caveat it and tell you that you can build any scan you want. Think of it this way. The scan files that I've shared with you, it's kind of like those boxes of colors, like the Crayola colors that come with like 64 colors. Like you can use those 64 colors to make a picture of anything, right? So it's like if I were to spend time saying, okay, draw me a zebra, Sam. Okay, here's a zebra. Okay, now draw me a squirrel. Okay, here's a squirrel. Okay, draw me a tree. It's an infinite rabbit hole. So what I'd like to do instead is just say, let me show you what I really use, which is this. And then you have the ingredients to build anything else that you want that's different. So this is what the Max Bull scan will look like. Ensure that you're using the one that I recently shared. But it should look like this when you load it up. I'm going to spend just a bit of time on it, not too much. Feel free to change anything up here, right? Like if you're looking for like smaller market cap stocks, my minimum is 10 billion. Yours might be, you might not even care. So change that if you wish. My minimum price to trigger anything is $20 on the stock. Some of you don't care. Some of you trade penny stocks or whatever. You can change that too. Everything else here I would probably keep, right? Because everything else here is kind of well defined. The scan is shared with a squeeze parameter. So feel free to, change that or remove it. You don't necessarily need it, but out of the box, it comes with a squeeze built-in parameter as well. So it's looking for, essentially, let's verbalize what this is looking for. What this is looking for is bullish setups with squeezes, right? So let's just run it, see what happens. Okay, so this is going to be the things that come up here. And again, what I'd like to do is actually just compare these to this. So this is, AJ's automatic sheet. I think this is pretty self-explanatory, guys. So what I really want to leave time for, a lot of time for, is the charts. So let's go ahead and move forward with this. I think all of that's self-explanatory. Anything that's not self-explanatory when it comes to the scans, contact our support team. CC me on it so I get a chance to see it. If you have questions about the weekly score sheet, or you want me to check your work, how many of you are brave enough to send me your score sheet and your work? Let's see. Sam@simplertrading.com if you do it. I'll check it out. So there's that. Let's go to the miscellaneous. Seasonality. Be aware of seasonality. We covered all of this. Stocks have the tendencies. This is the tendencies. Be aware that you're trying to line it up. Nothing is perfect, but it generally follows that tendency over a long period of time. Witching weeks, be aware of this. Also, make sure that you're staying around to the end because we're getting to the good parts. This is not the time to drop off. Witching weeks. Again, be aware of this. This kind of looks like a woman version of Powell, by the way. We don't need to spend a ton of time on this. Just be aware. March, June, September, December, third Friday expiration, witching weeks. They can be a little funky. The Fed, obviously be aware of what the Fed is doing, and the motto is don't fight the Fed. So fortunately, the Fed right now is pretty quiet with most things. Here's a key slide. Make this your own. So today you were given powerful tools and an instruction manual on how to use them. Make them your own. Make them whatever colors you want. Everything, as long as you don't change the integral data that goes into it. It can be. You can make it look any way you want. Your arrows can be pink for all I care. This is an example from my friend. This is one of the most god awful things I've ever seen in my life. It looks like a Barney abomination, and he likes it. I hate it. He likes it. Whatever. It's the same indicator. So make it your own, right? Make it completely your own. Make sure it resonates with you. It's the key thing. Make sure it resonates with you. Here's some notes that I keep on my desk or taped to my monitor. I probably need a nicer way to do this. Find a way to do something like this so that your signal is always in front of you. So I keep it on my monitor. I like this one, fully focused or fully flat. That's a big one. If you find yourself that you're not fully focused, that meaning that your mind is somewhere else, right? We're all human. Even as you sit here and you're listening to me, how many of you are thinking about something else? Let's do a little bit of internal audit here. You're sitting here right now thinking about me. One, how many of you thinking about what you're going to have for dinner? What you're going to be doing later? That thing that your wife said? Your kids? God forbid, it's something that happened 20 years ago. That the time that you were supposed to go out with the girl in college and you didn't. Just random things, because your mind is a monkey, right? It's a monkey. It's always chattering away. Even as you're sitting here, you're listening to me. You're trying to hold your attention on me. Somewhere in the back of your mind, you're thinking something else, right? So if that is the case, and it becomes to a point where it might be affecting your trading, fully focused or fully flat. So here's where it gets interesting. So I'm gonna take a big sip of water because we're about to get this is where I shine. This is my fun time. So bear with me for a second. I'm gonna take a big swig of water, make sure my throat is good. I'm a little parched, and I'll be right back with you. Sully says she was hot and is now rich. The college girl that you missed out on. I think about mine all the time too. There was this beautiful blonde that moved in next to me, just absolutely smoking. And I don't even remember. Somehow I got into her circle and like we became like not friends, but like we just started like chatting. And so I took her our first date. I took her to. It was actually an amazing first date. I took her to see the Led Zeppelin symphony. So there was a symphony in town that plays nothing but music from Led Zeppelin. And I was like, well, that's cool. So we went there and we have a good time. We go out to 6th Street, which is the bar street in Austin. We're drinking, we're having a good time. We're on the dance floor, first date, and they're playing Lady Gaga. I think the song's Love Game by Lady Gaga. And one of the lyrics is, "Don't think too much, just bust that stick. I want to take a ride on your disco stick." So the lyric says, "I want to take a ride on your disco stick." And every time that the hook plays that says, "I want to take a ride on your disco stick," she pushes her finger into my chest. And in the moment, I'm thinking, man, she really loves this song. It wasn't until years later that I realized that was a sign. And as a 40-year-old man, I still think about that. The monkey in the mind will chatter with the most random nonsense, so you have to cage it. So let's dive into some random thoughts. So the value of liquidity. Prioritize liquidity. The consistently lower liquidity equals better spreads and less slippage. It's going to be easier to exit. Always have an idea of where volatility is positioned. Remind me maybe at some point to give you guys my IV label before we head out. I'll put it in the room drive. Premium sellers usually win. Really important, open candle, open indicator. turn off extended hours for equities and leave them on for futures. We're going to get to the psychology part here in just a second. This is not the time to drop off, by the way. Most powerful time frames are those time frames. This is a new sentence thanks to one of my friends who was asking me about switching strategies minutes before the webinar. She was like, "What do you think about this strategy or that strategy?" So I decided to include this point, and it says, "Do not be promiscuous with your strategy." Why would I say it like that? Don't be promiscuous with your strategies. Stick with a strategy, right? If you find yourself that you're constantly chasing the next laser, ooh, shiny thing, ooh, big number, you will never get anywhere. If you find yourself that you're a tourist, meaning that you are in the mastering the trade room, and then I have a bad trade, because I'm the only one that ever has bad trades in there. Everybody else wins. I have a bad trade. You lose. You say, this room sucks. I'm going to go somewhere else. You then go to another room. That room has a bad trade. This room sucks. I'm going to go somewhere else. You will never find a home, nor will you ever grow. So, what I mean by do not be promiscuous with your strategies is focus in. Give them time to work. This is new for you. This indicator is brand new for you. Work with it for some time. Only after some time, if it's not working for you, change your strategy, but don't bounce around. Speak in the common tongue. What does that mean? When you speak, speak in terms of scores, structure, and levels, not ideas. Someone on Friday mentioned that higher interest rates would hurt the Russell more than the other indexes. How many of you would agree with that? Probably so, right? Russell has a bunch of garbage companies that are, mostly indebted. So higher rates hurts the Russell more. So what they said was factually true, and I agreed with it, right? But then as it hit my brain, I thought, well, that's not really a common tongue if we're talking technically, right? Higher rates will hit the Russell more. Technically true, but prove it. Okay, what's the common tongue? Well, now it's the indicators. So let's see if the Russell actually is in worse shape than its big brother, the NASDAQ, or the S&P. And it is. So in that instance, you see how now we've married two ideas. We've married two things. We married the correct factual statement, higher rates hurts the Russell most, with a technical signal. Then you have something. That's a big deal. Ideas are a dime a dozen. Can you tie it together with a technical signal? Here's another one. This is big. I can thank the room from last week for all of these. Don't try to explain the market. The only explanation needed is it is what it is. The funny thing is, when I started trading, if you told me that it was like, okay, explain why that happened or why did that happen, and somebody, let's say I had a mentor, and they said it is what it is, I would have been so annoyed. I was like, what kind of bullshit mentor are you? It is what it is? That's nonsense. And then I would go on a path of discovery to discover what's really driving it. I would find shadows in nothing. And guess what happens? I come full circle right back to where it started. And the explanation is it is what it is. It's a funny thing, guys. We always try to explain the market. Oh, it's going up because of this. It's going up because of that. Here's the thing. Price happens first, and then we tell ourselves a story to justify it. That's the reality of the dynamic. Our mind thinks it's going up because of the story, and in reality, we're creating the story because it's going up. Don't try to explain it. It is what it is. More random thoughts. Remember that stocks are priced in dollars. Dollars lose value, and therefore it's going to take more dollars to buy things. So therefore, stocks naturally have an upward drift because of unit dollar depreciation. If nothing else changes and just the dollar goes lower, stock prices go higher. It's a built-in cheat code, essentially, for stock prices. The second point, the game is rigged. Fed, politics, dollar, everything's too big to fail. Making money, I love this one, making money as a bear is so rare, they made a whole movie about it. Did that get a laugh from at least one of you? Making money as a bear is so rare, they made a whole movie about it. So lean bullish into the rig, right? I phrase this provocatively on purpose because I could have said manipulated, rigged, whatever it is. But here's the thing: it doesn't matter. If you're going to say that the market's rigged or manipulated, go with it. You know that you don't have to fight it. Go with it. Make money. Your job is to make money, not to, you know, yell at the market. So understand that it is rigged by design in an incredibly heavy way. Lean into that. And this is this little segue here is for my perma bears out there. You're fighting powerful forces beyond logic. So don't be a perma bear. Be able to explain every pixel on your screen. So one little bit of homework for you tomorrow as you go through and you set things up, make sure you can explain everything on your screen. Prioritize liquidity and high activity stocks because illiquid instruments will move more erratically. This is important because it's going to affect your indicators. The more liquid it is, the more reliable the signals will become. 1 million people is easier to read than 10 people. It's paradoxical, but it's true. You will find more success by focusing on a handful of stocks and learning their personality than trading everything that pops up on a scan. Additional resources. We're almost getting to the good part. Books to read. There's this guy I know named John Carter. I broke into his office and stole some art from him. You might have heard the story. Mark Douglas for trading psychology, John Murphy for charts and intermarket, Steve Nyson for anything candlestick, Austrian economics to understand how the world should work, although that's should and is different, but Austrian economics for that, and then Alan Watts just to take care of your brain. Alan Watts tapped into the software of humans. Bookmark some of his stuff on YouTube. And speaking of, the psychology game. Patience is the game. Most of trading is waiting and being patient and waiting for your setup to appear. Most of what you will see during the trading day is noise. That's okay. That's a feature, not a bug. Don't force it. Wait for your signal. Don't try to touch all the water. A part of learning something new that can be exciting at first. How many of you were excited when you got the indicators? I mean, I was excited when I got the spreadsheet, so I would imagine you guys were excited when you got the indicators, right? It's a new thing, right? You get the chance to use them. Some of you have been using them very successfully already, even before the class. And it can be exciting. But you don't have to learn everything all at once. In trading, like in many things, one can have great success by finding their niche and just mastering one or two things. As important as I think it is to touch base on the big picture, traders have to be able to remain adaptive in the line of fire. The more things that you're trying to juggle, the less likely that you will stall or not react in the line of fire, right? You could spend your entire life reading about war and shooting guns, but the moment that a bullet whizzes by your helmet, if you freeze, what was it worth? The solution for this is to prune the information, only take what is best and discard the rest. And it's good to get up and take a walk every once in a while. This is another one of those art pieces from John. I probably should have asked for this one too. Maybe after this class I will. Everyone wants to be Cortez. Nobody wants to burn their ships. What does that mean? Sometimes the only way to move forward is to make it the only choice. Are you guys familiar with the story, the Cortez story? Cortez is in Europe. He wants to take land and treasure. And it's very easy to think that. So you get a bunch of men on a boat, you sail them across the Atlantic, you land them somewhere around Mexico, South America, and then things start to get hard. And the men are hungry, and they're tired, and they're cold, they're missing their wife, and they want to go home. They're telling Cortez, let's go. This is uncomfortable. I miss my wife. It's cold. I got bitten by a boar. And so what does Cortez do? He burns the ships. He makes it no choice. There is no way back home. We have to conquer. Trading is difficult and rewarding, but my goal is to give you the tools to succeed. If you have the spirit to burn the ships and be the best version of yourself, then you will succeed. So you guys remember this one from the webinar, but I want you to think about this and make it your own. Don't, as I tell you my story, process it, but ask yourself, what is really going to give me this feeling? Even before, even before I see the slide, I already feel it. And I hope you guys have something like that, something that where you think about it and you have that moment that I just had, where it's like I couldn't even talk. It felt like my heart dropped into my stomach in a good way because it's like too big. It's too big for my chest. Find something like that because you need a North Star to guide you during what's going to be a long journey of a trader, right? And you need that North Star that is your constant guide during difficult times. And so the question that I pose to you is, what motivates you more than anything else? And it could be a lot of different things. It could be family, it could be freedom. You could like nice things, right? Taylor wants a brand new BMW, and it's a badass car, and I bet it goes really fast. But whatever it is that motivates you, tap into that. For me, it's always been animals, and my goal is to start an animal sanctuary with my trading, and I'm going to name it Amanda's House. After the person who helped me embrace trading. So here's an interesting slide. And it starts with a little bit of a story. And we're going to go over on our time, guys. If I hope that's okay. Are you guys okay with that? We might go to 5. We might be going another 90 minutes if that's okay with you. Either I rush it or we go over. And it's Saturday. Hopefully you're comfortable. So let's just go for it. So this is the irony of need, and it starts with a story. So when I was whatever age you are when you're in 7th grade, no, it wasn't 7th. Yeah, it was 7th. I was like 11 or 10 years old. I don't know what age that is or grade. I was like 10 or 11 years old, and I'm walking home from school. And I grew up really poor. My mom never made more than $8 an hour growing up. And I'm walking home from school, and I'm crossing the street, crossing the crosswalk or whatever. And there's this lady handing out flyers, and the flyer says, if you're a kid and you want a job, call this number. So I call the job or I call the number, and they're like, great. What's your address? We'll come pick you up tomorrow. So the next day, I get home from school. A white, unmarked van shows up. And they open it, and there's a bunch of kids in the back, and a big fat bald white guy driving the van, and his wife is next to him. So unmarked white van, very safe. And it turns out that what they do is they get a bunch of kids from the hood, and they give them totes, like these big rubber totes, Minute Maid or whatever it's called, Rubbermaid totes, and you go knocking door to door and you sell stuff. So he would pick us up every day. He'd take us to different neighborhoods, and every kid would have a street, and then they would walk up and down the street knocking on the doors, and then hopefully sell stuff, and then he would pick us all up and take us home, and we'd get like 10 or 20% of what we sold. So I did that for a while, and it turns out I was pretty good at it. Every day I was making like $75 to $90 a day, which I was making more than my mom at like 10 years old. So put yourself in my shoes on that one. And I started getting a little bit of money, right? And I would never spend it because I'm a kid. I don't have anything to spend it on, so I just save it. And I get home one day, and I'm putting my money away, and I'm putting it, all the fives go here, the tens go here, the 20s go here. And my mom's watching me from across the room, and she's quiet. And then I feel her just looking at me, and I look up, and she's just looking at me. And I go, why are you staring at me? And she goes, do you know why you will always do you know why you will always have more than you need? And a little bit of background on my mom. We've always had an inverse relationship. I'm the parent. I was the parent at that age. I was making more money than her, and I was the parent in a lot of other ways. So we have this flip-flop relationship. So I've never gotten good advice from my mom. It's just the way it is. I love her. She's a great person. She's the nicest person in the world. She'll give you the shirt off her back, truly. And but she's just not someone that's going to give advice because she doesn't have a lot of experience. So this was stuck with me. She said, "Do you know why you'll always have more than you need?" And she said, and then I go, "No." And she goes, "Because you don't need it." And it's true. The reason that things were magnetic to me was because I wasn't trying to hold on. And so the point of this is that the more that you need something, the more you will find that it will run away from you. The more that you chase after it, the faster it will run away. So the way that you resolve this, and we've all experienced this, you all have experienced this in your life, where it's almost like, I don't want to say the word desperation, but that captures the essence. You're just trying too hard, and it's like water in your hands, and you're squeezing it. And you're trying to hold the water in your hands, and you're so afraid it's going to go somewhere that you squeeze it. And then get what happens when you squeeze it. Then it goes somewhere. The very act of trying to hold it creates the release of it. The way you fix that is you slow down, you remove the need, and then it will come to you. Also, I really love this little dollar sign running away. Closing thoughts. Go slow with new ideas. Allow for the strategy and the indicators to prove themselves to you first with smaller trades before letting loose. Find time to fiercely focus. Find joy in disconnecting. After this is over, disconnect. Let it go. All of this will keep working in your subconscious. You don't need to study anymore today. You've studied enough today. It's been a 5-hour class. It's going to be a 5-hour class. This is enough. Go have some fun after this. Find joy in disconnecting. The stock market is the greatest psychologist on earth. You cannot lie to it. Trading will reveal who you really are to yourself. It's not you against the market because the market doesn't even know you exist. It's you against you. Remember to take care of your body as well as your mind. We are all here because we're type A personalities, and what we do is very mental, but it is a circular thing with your body. So stretch, lift, move things, stay physically healthy so your mind and body connection remains strong. Ask yourself, what is really your goal? Is it to be right or to make money? If it's to make money, then follow the things that we've talked about in terms of speaking the common tongue, not forcing your opinions, letting go of your belief systems and all of this stories that we tell ourselves. Remember, if your goal is to make money, the best sentence that you can say is, "It is what it is." In trading, your mind is your tool and your weapon. Keep it sharp. A disciplined mind, a trading edge, and risk management will lead to success. And lastly, let go. Going back to the original point of this entire endeavor, the secondary point was the indicators. The first part was to remind you to let go. You're not in control, and it was never yours to hold on to. So let go. And then lastly, in a weird way, the market gives its participants exactly what they want. Said by a young, handsome philosopher named John Carter. The best quote I ever heard was said by a homeless man, and I would like to share it with you. Life, what a gift. How lucky you got in. A man who had nothing but gratitude for life is something that I never forgot. I actually have it written down. It's an ancient postcard. It's probably 30 years old, no, 20 years old now. Life, what a gift. How lucky you got in. The improbability of it all. As traders, it is easy to get caught up in our own experiences and the noise of the world. One of the strongest methods I have found to counter this noisy energy is to overwhelm it with a stronger energy, which is most often gratitude. I find that I can easily get to that place by remembering one thing: the sheer improbability of this very moment. Now, whatever you believe, the probability that you and I would be having this moment together, connected by silicon and electrons, is incredible. The probability of that any of this exists at all, even when it seems bad, is amazing, and the idea overwhelms me in times of stress in a very positive light. At some point, billions of years ago, every atom in you, and every atom in me, and every atom that exists and will ever exist was one. Whatever this is, it's bigger than us. So this is the very last slide, and then we're going to go into some chart work here, because I think that's the most important part, and I want to spend a good chunk of time on that, or at least the remaining time that we have together. So thanks for spending your afternoon with me. It's not over yet. We're going to cover we're going to do a Q&A, we're going to do charts. I hope that everything that we have covered, from the indicators to the strategies, will help you become a better and more profitable trader for the long run. I'm happy to be a small part of your growth as a trader, and if you need anything from me, shoot me an email. I'll see all of you in the live trading. It says have a great rest of your day, but we're not done yet. So let's do some Q&A, right? You guys must have some good questions, so let's get through those, and then we'll do maybe a bit of chart work. How to use the Squeeze Ultra with the TMS. So I'm just going to start from the 342 comment. So anything asked before that, just copy and paste it again. I'm going to start with Lon's comment here. How do you use the Squeeze Ultra with the TMS system? So nothing really changes. I would say that if the Squeeze Ultra is saying that it's an ideal squeeze, and then you have a bullish alignment on the indicator, that is an additional confirmation. In the event that it does not say it's an ideal squeeze, I always prioritize our indicators. So if Squeeze Ultra is aligned, even better. If it's not aligned, I always go with mine. Steve with the raspberries. What's the candle color logic again? So that is the same as I showed you in the slides. So it is actually in the presentation. Just go back to that part of it. 95 and higher is going to be dark green. 75 to 94 is going to be regular green, bright green. 74 to 45 is going to be blue or neutral up. I'm doing these from memory, but they are in the slides. Does the indicator show differently between SPY or SPX? It may, just because they're going to be different data, right? So they're going to be slightly different data, despite the fact that they're roughly tracking the same product. Look at Microsoft 15-minute. We had on the last sell bar, so that may leave Monday until 4 bars close. I don't think so. We can start looking at charts here. Let's do it. Let's do it this way. No, actually, the repainting issue is, I don't really find that to be that much of an issue, guys. I really don't. Just because, one, I'm aware of it, so I know the windows that it works on, and then two, this idea of like I'm going to catch the, so let's go back to this example because it's a current one, and it's actually a perfect one. So this trigger on SanDisk, let's break this down. How did this happen? Okay, so these two signals are completely clean, and there's no issue there, and they will never repaint. This one, as we talked about, did not actually trigger until this bar here, right? Because the pullback collapsed the true momentum. It triggered a sell here, but in reality, you can actually ignore this. This actually has no input into this conversation. Really what happened is on this bar right here, the true momentum collapsed onto itself. Let me explain what I mean by that. You see how it is now negative? That happened on this bar here. So because it works on the window, it's a 5-day window because it's a weekly look back. It then retroactively prints it here, right? Here's the thing. Some might say, well, I want it to print exactly on the bar. The only reason that this indicator is so good is because it's referencing the higher time frame. So I don't have a way to adjust that. It's just something that I recognize and I deal with. But let me actually really just say what I want to say. This idea that you're going to nail this at 1600 or any instrument to the absolute nut high is so amateur hour, it makes me want to pour another shot. It's just not the way trading works, and it's amateur hour. I'm not trying to call anyone out. I'm not, because I don't know any names, but it's amateur hour. Here's what trading really is. Trading is, you'll have the topping process, you'll have the bottoming process. This will be like 10% of the game. This is 10% of the game. And your job as a trader is to catch this, right? 80%. So this idea that like you would expect something that triggers at the absolute high to the penny, or let me rephrase it, whether it triggers at the absolute high to the penny or whether it triggers 3 bars later and then causes an 80% of the move, that's irrelevant to me, right? As a trader who has experience, I understand that the game is in the middle, right? So the idea that, let's say that this is a lasting top. Let's just play it out, right? Like, let's just say that this is as high as SanDisk will ever get, and then every bar from here is just going to look like that after it has a sell signal. Where would the entry be? The entry would have triggered on this bar here, right? It would have lit up on your system that that's a sell. Okay, let's say that that's the high from all time, right? Am I going to be upset that I didn't catch this when I'm catching this? Let me give you another example real quick. AMD. AMD is not a great example. That's actually too clean. Intel's not a good example. That's too clean. Let me think of one that's clean. That's Microsoft might be a good one. Okay, let's use this example. Okay, this is kind of a SanDisk-ish example. So, looks like it nailed the absolute high there, right? What really happened? Where did this really trigger? This triggered on the collapse of the lines. So this sell that retroactively triggered is probably triggering here. Okay? So let's really think about this for a second, right? Let's be professionals, because the ones of you that have lasted this long, let's be professionals here in terms of what is really our goal. Okay, so this says sell here, but it really, the sell happened, or the sell triggered here on this bar, and then because it's a 5-bar window, because the weekly bar is not closed, then it would have printed here, right? But in reality, you would not have seen a signal to sell until probably this bar here, right? Okay, now that we understand that, and that roughly is going to be around 458. Okay, so let's keep that number in mind. If you had shorted the absolute high of this candle, it's 467. Let's say 460. Let's just say 467 and 458. Okay, what was the end result of that? Oh no, I'm 2 bars late. Well, it doesn't matter. Look, if it triggers here, or if it triggers here, the end result is that. So I'm not going to be too concerned. I'm not going to change the entire indicator for that when the payoff is that. You get what I'm saying? So I just wanted to go back to that point because I want to be really clear as to, yes, that is a thing that it does, but it is just the limitation of the indicator because it has a look back period of a higher time frame, right? If I had it on the same time frame, I could do that, but it's just going to be incredibly noisy and it would not be anywhere near as accurate. So just a point there on that one. Actually, you got me on that one because you brought up Microsoft. So let's take a look. I was already on Microsoft, fortunately, so I'll just change the time frame. 15 minutes. We had a 15-minute sell on the last bar. Okay, so Will this reverse? No, this will not reverse. This is locked in place. Now, what can happen is this will not reverse no matter what. But what can happen is that, let's say Microsoft gaps up. Let's say what something nutty happens and it gaps up, right? So then you'll have a sell signal, but then it gaps up on Monday. That will then trigger a buy. Okay. But that's not the expectation. The expectation that I would have going into this, into next week, is that Microsoft is going into next week as a sell. So, but understand, this bar's locked at this point because all bars have locked. There's no there's no higher time frame to reference at this point, right? Does that make sense? Like the 15 minute is not referencing the weekly time frame. The 15 minutes referencing the hourly time frame. The hourly bar has closed. This signal is locked. No matter what happens, whether Microsoft does this and the signal looks like a genius, or whether it does this and gets bought out by Apple for $50 trillion and the signal looks stupid, it doesn't matter what it does next. It actually is locked. However, as someone who is using these indicators, I would understand. I would have to view this as the probability that the continuation will be lower. There's no way I can look at that otherwise. So I see that signal. I'm not even doubting it. You know what I mean? Like I would just go with it because that's the current signal. And if it's wrong, guess what? It's trading, right? Probabilities, that signal, the totality of my signals are going to be correct much more than they're going to be wrong. You have to accept that trading is probabilities. And I know you know this. I mean, I know you're in the MTT, but I'm just saying it for the folks out there that are like, I want to catch every single low and every single high, and I never want to take any risk. You'd be surprised how some people think. So I just have to say it. If you're playing a daily time frame, do I need to wait a week before it's confirmed? Give me a chart that you're looking at so that we can speak the common tongue. Yeah, that's probably the best way to do this is give me the chart that you're looking at so that I can look at it with you, and then we can, because I don't want to talk in abstractions. So give me charts. And I'll come back to you, but give me a chart and I'll see it. MU has pulled back from the fourth ATR to the second ATR. What lower time frame would you look to buy a signal? Oh man. All right, so that's a complicated one, but let's take a look real quick. Okay, so there's ways to open this up. Don't post in the chat because I don't want to clutter the chat with things that are not questions. But a 75 bull, where is this going to trigger? Is this going to trigger a buy here or here? It's going to trigger a buy at the 21. Okay. Now, let's say, for example, that you think that maybe you can go inside of this and finesse it a little bit more. Okay, fair enough. I wouldn't be looking, the correct place to buy this, barring something changing, is the 20. That's where it's going to trigger the buy. But let's say you wanted to finesse it. This kind of goes into the multiple time frame analysis stuff. Okay, well, if I wanted to finesse it, how would I do that? I would wait for an hourly arrow to turn. Basically, this. So, MU on the daily has an uptrend. Here on the hourly, it had a down arrow. That down arrow went nowhere. It basically was sideways, and then it gave you an immediate up signal yet again. That's your trigger. So exactly this. So notice the similarities. Let's say on Monday, it gives an up arrow right away. I mean, probably will in this market. Then that's your signal to get in. However, I wouldn't approach it that way. I would approach it as right now you need that up arrow, and the path is lower until you get it. And then I would look much more closely near the 21. My arrows on the chart don't look like your arrows. Yeah, that was a limitation. So thanks for bringing that up. That was a limitation on export. So when I export these arrows, no matter what machine I do it from, TOS cannot handle special characters. And I had to use different characters for your arrows. At the end of the day, they mean the same. They'll be in the exact same place. But that was a limitation in terms of how I could export it. Bear scan, bull scan, lower time frame. I don't know what that means. If you can maybe expand. Just to be clear, the bar colors are delayed based on the higher time frame interval, like buy or sell bubbles are. I think you guys might be overcomplicating it a little bit. I don't know if I don't know if how well of a job I did on that, but this idea that everything is delayed is completely incorrect. Here's the way it works. And it's very important to understand this. I will go back and explain this. This idea that everything's delayed is not correct. The only time that you'll get any type of weirdness like that is if you get a later stage change in price. So let me go back to the SanDisk analogy or SanDisk example. So here on SanDisk, chances are this is a Monday bar, this is a Friday bar. Chances are that this bar that did absolutely nothing, it was basically like a slightly up bar with not a big range necessarily, didn't change the indicator, right? It's not changing the structure. The moving averages are not going to change from a tiny bar. This was clearly not changing yet, right? And therefore, I would very much guess that the true momentum was still completely fine on that bar. It wasn't until one of these three bars, and I don't know which one because I wasn't watching this live, but I'm just using this as an example, that the pullback happens, that then this causes this to collapse. Once this collapses, what do you guys know about this? This is the most important indicator. Therefore, this entire thing goes gray, right? In reality, I think that it's one of those things that you just have to use, right? Because I don't know if I've done a great job of explaining how it all works. Because if there's a belief out there that like these types will reprint, that's not the case. The only time that they will reprint is when the true momentum lines rapidly collapse onto themselves. So maybe the way I should have said it earlier. The only way that this will reprint, let me be very specific and bold here. The only way that anything will reprint is if all of a sudden the true momentum lines collapse onto themselves, right, rapidly. If they do not do that, then there will be no reprinting. But if they do that, then the look back period of the true momentum is what comes into play. Please explain your methods for adding to a trade if it pulls back and gives you a secondary input to get into. So let's see, has AMD done that? No. Did Intel ever do that? Intel gave one buy signal and never another one. I'm trying to think of another one here. Maybe QQQ. Man, everything's so strong, it's hard to find something that's like giving multiple entries. Let's just use this example. So adding to a trade, as long as it still meets your trade parameters and you're still within your risk tolerance, every time that it pulls into a buy zone, it's going to re-trigger a buy. So any of those would be opportunities to add to the trade. Now, I wouldn't necessarily view it as, every arrow is a must add. That comes up to you. But essentially, if you really understand it deeply, the arrows and the bubbles are doing so much of the work. Let me actually change this back to buy and sell, because they've already factored in where you should be buying and the score necessary to buy where. So there's really no necessarily much of a thought process anymore. If you're looking to add, you can always add on the next buy bubble, but with the caveat that you do not necessarily have to add. Hopefully that makes sense. So this is such a funny question. So have you stress tested these indicators to know they are accurate? What percentage of accuracy? How do I say this? Your accuracy is going to depend on your own. Let me pull up like the cues. So I don't know. You tell me. I mean, I think it's all there for you. All the work is on the chart. Even if you ignore, let me put it like this. Let me come put the ball back in your court. Ignore these. Ignore those. All white signals. Ignore them, and then just look at the trend continuation signals, and you tell me. How many bars after a bubble signal do you feel the signal is still valid? Is it something like the squeeze where it's 8 to 10 bars? No, I mean, it's indefinitely valid until the next signal happens. So let me expand my. I'm trying to think of something that has triggered nothing but eyes. I think Ross was like absurd. Yeah. So something like this. So how many times is it valid? I don't think there's a number. I think it's valid until it's no longer valid. I understand your question. You're asking whether it's kind of like a squeeze where it goes 8 to 10 bars before it kind of stops. I don't find that behavior to be necessarily true, although you got me thinking. I'm going to start paying attention to that and see if there's might be some validity to it. But it's just going to go until the signal shift. So I don't put a expiration date on it. Does the swing level of 100 include the 50s plus the hundreds? No. The swing level, basically, the way that that works is, what's the best way to show you? I'm trying to find something that's like sideways. I'm just going to have to sketch it out, I think. So, swing levels. Work off of recent highs, right? So for example, let's say that I have a chart that kind of looks like this. Right? I'm just going to drawing a general one. Okay, so if I have like really long-term swing levels, like let's say 100, then my swing levels would look like this. Okay? Let's say that your swing levels were like 10. Then you would have swing levels here and here and here, right? So really the best way to do that is actually just to test it out on your own and just see what makes sense to you. For me, I use 50 and 100, but some of you might want more. No, there's no max bear scan. I didn't make it because it's going to be so infrequently used. You can make it yourself. You can just basically invert the bull scan that I shared, and then you have all the pieces for it. Okay, so how do I use the indicators to know when to buy or sell? So literally the entire class, we just covered that. Should the indicators be on regular trading hours? Yes. Only for cash products. Futures would keep the overnight on. Day trading a 50-minute chart, do you recommend both high-low and trend or just trend? Use everything holistically. I would never split anything apart. So the only way that I would ever say to use high-low, so maybe this is a segue into something good. Let me think of an example here. Because this idea of splitting the indicators apart doesn't make a ton of sense to me. But it does make sense in one specific case. So let's use this one. Yeah, this is a good example. So here, this is a perfect example. So here you got to sell, right? Here you got to sell. And again, just to go back to this sell would have probably triggered here in reality, right? This is a chunk of bars. It doesn't really matter because look at that signal before it drops, right? But here's where it matters. You see how you have a sell here? Somebody might say, okay, what's a sell here? It never triggered a buy, right? So in this instance, and keep in mind, we covered this a lot. So make me proud, guys. Make me proud that you've been paying attention because we covered this. But I'm happy for the question because it gives me a chance to really hammer this home because this is a really important thing, and it's a really simple thing. There's going to be gaps in the logic for grays. There's no clean way, guys, to code gray bars. Think about it. It's like I show you an ink blot test and I tell you what does it look like. You say a cat. I show it to somebody else. They say a bat. I show it to somebody else. They say a dog, right? And so there's this. There's no clean way to code grayness, and nor do you really want to, in my opinion, because it's a mess. But there is a fix. There is a patch. There is a patch. Remember that when the bars are gray, and this is super simple, guys, but really powerful. When the bars are gray, your only signal is high-low. So yes, did it tell you to sell here? And does that, is that a good signal based on this right there that happened before it dropped? Yeah, that's a pretty good signal. Could somebody say, well, then why did I not get a buy signal for that entire move? Well, I don't have a signal that would trigger from gray to gray to gray, but what I do have is a trick that works in every situation when it's gray. Gray bars, I want to be really clear. Gray bars use high-low. Colored bars use everything else. Gray bars use high-low. No, George, there's no way to do it. I mean, there's just no way to work around that. Here's the thing: the higher time frame stuff is absolutely necessary for the indicator to work the way that it does. You guys seem to be kind of focusing more on these like one-off kind of things when in reality it's an 80-20 kind of situation. It's actually perfectly that. 80% of the time it's not an issue whatsoever, and 80% of the time you end up with some of the most sophisticated, strongest possible signals that wreck and destroy everything else that's out there. 20% of the time you do have to think a little bit, and I've shown you every kind of way to think about it, where you have to ask, okay, what's really going on here, right? Kind of like the SanDisk example would be one of them. So if it was 20/80 the other way, then I would think it's an issue, but it's really not that big of an issue. Here's what I would say: use the indicators, just use them, and you'll find for yourself that it's probably less than an 80-20 issue overall. In terms of changing it to not use higher time frames, there's no way to do that, at least right now, that I can possibly think of, that does not completely increase the amount of noise in the system to a point that none of you would even like to use it, myself included. No, this is a product of 9 years of work. The indicator initially started by looking at the time frame that it's on, and then the amount of noise was made it unusable. I mean, if you can go back and look at my webinar 1, I showed you the first iteration of it. By introducing the higher time frame aspect of it, that's what made it a star. But the problem that it develops is that when you have the white bubbles, then when you show it to folks, they can say, well, that happened on Tuesday and now it's Friday, and I'm 2 days late. Well, it's an 80-20 issue. And whenever you have like a white bubble, you can always use a smaller time frame to go with that. So most of the time, it's really not that big of an issue. Where does high or low volume fit into the equations? It doesn't factor into the system at all. There's no volume input. So if it's high volume or low volume, the system's completely blind to it because it's not looking at volume whatsoever. I do like the question though because it allows me the chance to say something very quick on volume, and that is that I think the traditional understanding of volume is probably flawed to some degree, because if I throw volume on this chart, all of this rally except for Friday is on low volume, right? So most people, I think, have this idea that high volume equals conviction. And I think high volume equals conviction as it breaks out through a level, but not necessarily in a trend. So I'll answer your question that volume doesn't factor into the study whatsoever, but it allows me maybe a more interesting segue to say that low volume and uptrends in this market is actually a feature, not a bug. So maybe also review how you view volume and see if it makes, see if you're kind of viewing it the same way or not. So I look at volume as needing to be high for breakouts, like breakouts through a level. I want high volume. But for trend moves like this, as I'm showing you, you can see the volume for yourself. The white line is the average volume, and look, it's like radically below average, and this has been the biggest rally of, you know, that I've seen in probably forever. When filling in the weekly score sheet, occasionally one of the scores comes up as neutral in A. Would that count as zero? Something else? Example is A Lab weekly score. Let's see. Oh, I see. I get what you mean even before I look at it. Yeah, so in that instance, that means that there's not enough data. So you're seeing this. Yeah, thanks for bringing this up. See, this is what's helpful because you guys catch all these little like peripheral things. Yeah, there's just not enough data here for the indicator. So the high-low has data. The true momentum doesn't seem to have enough data. There's something that's missing here. I'm not sure. There's actually, this is a little bit. Oh, you know what it is? I know what it is. I know what it is. It doesn't have a 200 period moving average. I can maybe fix that. I worked on it, but I couldn't find a way to fix it. But I could maybe fix it. So you see how it has a momentum input? So it actually is registering correctly with the indicators. It has been for a while, but it doesn't have a trend input. And the reason it doesn't have a trend input is because it doesn't have a 200 period simple moving average. And so the indicator doesn't work. So you would need 200, you need 200 bars to have that, and this doesn't have it. Honestly, in this case for A-Lab, I would probably just go ahead and write down 100, because the goal that I have for you guys is that you can kind of see this chart and tell me what the score is. Like maybe that would be actually a really good way to finish the class is I pull up charts, I cover the score, and you guys tell me what you think. So maybe just a thought experiment, but here on A-Lab, this would be very close to 100. Both lines are positively crossed. There's a big spread between. Both are above 50. You're getting max points for that. This is thrust confirmed. You're getting max points for that. You have the 8 above the 21 above the 50. The 200, whenever it populates, will probably be somewhere in that neighborhood. This is a 100% chart. Somebody's looking at Tesla on the daily, and you're talking about daily candles are colored green, but it says neutral on True Momentum. Interesting. Ah, I see. Hmm. Hmm. Funny thing is, I know what it is, but it's not an issue. But I can kind of see from your perspective how I would look like that. So here's what it is. This line is below 50. This line is above 50. The only way that that's ever going to not be neutral is if the difference between these two lines was 10. So you see how it's a 48 half and a 56, let's say 56 half. So the spread there is 8 roughly. So what's the reason that this is neutral is because this line's above 50, this line's below 50, and the spread is 8. If it was 10 or greater, it would override that and make it positive. No, I mean I always go with the score here, and even if you did use, so let's say that you followed the process, you said, okay, that's neutral, look here, if that's still giving you the same thing. What I would rather you do is if you have gray bars, right? If you have gray bars, not necessarily gray here, although they do tend to work in tandem. I would say this is actually somewhat of an anomaly. It's very rare to have neutral here and green here. So this is a little bit of a like an outlier. Most of the time, the vast majority of the time, I don't recall the last time I've seen this, the vast majority of the time, if it's neutral here, the bars are going to be gray. And if the bars are gray, then you do old reliable and you look down there. Yeah, T money. I think that's a correct. That's probably the accurate way to say it. The system isn't built for catching white bars. It's for catching after the white bar and the trend that follows. Yeah, it kind of goes back to my 80-20 point. And he's saying I think people are thinking this is supposed to catch the very high or the very low. Here's what I'll say: if you find an indicator that catches every high and every low, let me know what that is, and I will give you my entire net worth for it. I have not come across that one yet. No, the goal, guys, I want to be super clear because we want to be, we have different skill levels of all different types, and I want to be somewhat respectful. But it is, and I'll excuse this little bit of Sam slipping through as as I can't control my filter, but it is an amateur way of thinking to think that the game is to catch this right there or this right there. That is not, that's just, let me just speak openly because I'm wasting a lot of mental energy putting a filter on myself. That is the most amateur nonsense I've heard in a long time. That's not the game. That's just not the game. The game, and you guys know this, the game is from the third inning to the seventh inning, right? Third inning to seventh inning. Let somebody else have the first to the second and the ninth inning. The game is found in the middle. The buy signal uses the same logic as the sell signal. Let's show up in the closing of. Okay, yes, we've covered that. Do you use Russell or ATH for stocks or ETFs? Look at the difference between ETH or RTH. There's not any difference. What's the? Oh, regular trading extended session. Okay, sorry. I was reading ETH as Ethereum. Do you use regular trading hours or extended trading hours for stocks and ETFs? Signals look different between. So if you're looking at stocks and ETFs, which are regular trading, cash hours instruments, always have extended hours off because yes, the signals will look different because as they should, because when you have extended hours, you have a bunch more bars that the indicator's looking at. So for everything that I do, I turn extended hours off, and only for futures do I keep it on. Now, at the end of the day, you can do it however you want, right? But that is best practice, and extended session hours, especially on illiquid things, is going to introduce a lot of junk data. Okay, I'm not entirely sure what the question is on Microsoft here, so maybe give it to me worded in a slightly different way. Okay, so let's go back to SPY. So I'm kind of questioning whether I did my job here today or not on some of these questions. Okay, so guys, let's really get down on this one. Okay, remember, this is really important for the purposes of repainting. Let's blow this up. The only thing we need is this. There's a difference, guys. The SPY chart will never repaint. There's a zero. There's a 0.01% chance this would ever repaint. Why is that? Because the spread is colossal. So yes, you can have a down day, you can have another down day, you can have another down day. This is never going to reprint because the spread. The only thing that's going to happen is the fast line is going to get closer to the slow. but it's not going to reprint because the spread is too big. So there'll never be an issue here. The issue is when it looks like this, and then on Friday you get a down day, right? So when it looks like this, this will never reprint. Also, this is really important. I'm kind of questioning myself here now. The idea that you're going to get a down bar here, a sell signal on Friday, is just not even remotely a possibility. So let's think this through. Maybe I should have asked for questions earlier because, damn. Okay, let's think this through. But I appreciate it. I appreciate the question. I truly do because it identifies a weak point potentially in how I presented this that I maybe was not aware of because I thought it was self-evident. Okay, so my goal with you, aside from the let go, my secondary goal for you was so that you could read the indicators and understand how the score works, right? So let's look at this. The 8 is here, the 21 is here, the 50 is here, and the 200 is here. Okay. From a structural perspective, what has changed? It was a down 90 points, right? That's a big move. But what has changed here? Did anything change from a structural trend input perspective? Not at all. So the trend is still max bull, despite the fact that it was down 90 points. Okay, so there's no change there. We can identify that. That's not going to change. We get max points for trend based on how we've defined trend. The 10 is above the 20, is above the 50, is above the 200. And frankly, that's going to stay that way for a while unless something massive happens. Okay, so trend is not changed. Let's move on to true momentum. Okay, we had a down day. Okay, well, you see how much cushion this thing has? So let's say that on Monday it kind of looks like that. And then on Tuesday it looks kind of like that. Will this still be positively positioned with the lines like this as opposed to how they are now? I'm actually going to ask for feedback on this one. Yes or no? Yes, right? Yeah, let me draw it in again, right? So even if you collapse, this is still above 50, fast above slow. This is going to be giving you points for a while. The only way that you're going to lose points on a down day, and actually thank you for bringing the question up because this is important. The first thing that's going to crack in either in a trend shift is going to be this guy, right? In the same way that, perfect example, nice little arrow at the lows. Thank you very much, high low. No bad signals since. Thank you very much, high low. But look at the arrow there. Notice how this arrow was happening before this arrow. So what do you think is going to happen on the other end of this? More than likely, there's going to be an arrow here at some point, and then at a later point, there will be an arrow here, right? Similar to this. You see what I'm saying here, right? So in this instance of SPY, the first and only thing that's going to crack first is going to be the high-low. So you might get an arrow, let's say that Tuesday's limit down. Let's not be so dramatic. Let's say 2% down. Then you'll get an arrow down on high-low. Okay. Well, and this it was important, and for those of you who stuck around, you'll get this little bit of gold. If you have an arrow down on high-low, right, but this is still good, and this is still good, what's your score going to be? This is an impossible question. I'll have to give you the answer because I didn't tell you. In this instance, your score drops to 75%. Okay, well, you do know this. A 75%, is that a bullish, neutral? What is that? It's still bullish, right? If anything, 75% means you buy at the 21 or the 20. Okay, so thanks for bringing this example up because I think maybe this shows some gaps in what I thought was a well-ordered presentation, but I guess this is something that's important. So no, the idea that SPY would ever show a sell in this condition, given the amount of fat that the bulls have to work with this pattern, it's just not going to happen. The very first thing, and then I'll move on to the next question, but this was a good one. The very next thing that's going to happen, if there's going to be any weakness in SPY, it'll crack first on high-low. And then from there it'll spill over, but you're not even there yet. Okay, I kind of lost my place here. Bear with me. Now let me show you a different example. Maybe I could find one. Let's see. Not a particularly good one. Let me think of another one. Now that I'm looking at this XBI chart, this is disgusting. You see how XBI is making all these moves? This is neither here nor there. I was just looking for an example. You see how XBI is making all these moves here with gray bars with a negative momentum? That looks like a short. All right, so let me keep answering questions as much as I can. Do you trade 0 DTE SPX? If so, any suggestions? The question would have to be a little bit more broader, more narrow than that, because you've already chosen an instrument and you have the indicators to guide the way. If you're trading 0-day SPX, actually, you know what? My first suggestion to you is to throw the comment of have you earned it back at you? Have you earned the ability to trade a 0 DTE SPX? Meaning, have you done it successfully enough times to where that could be a viable strategy? If you're newer to 0 DTE SPX, my actual suggestion is actually to use maybe 3 or 5 day. They're going to move the same, but it'll be slower, more gentle. You will have to close the trade. You can't just let them expire like you can 0 DTE sometimes. But the process will be a little bit less noisy. It'll be a little bit more reliable. So my advice, without knowing anything else aside from that question, is if you are newer to 0-day SPX, consider using 2 or 3 day SPX as a gentle introduction to it. Is Microsoft a buy on the daily chart? It's a user's choice. It's not a short. It's never a short. It's too strong for it to be a short, but it's a gray bar. So what do we do with gray bars? We rely on this. Thrust is unconfirmed. Okay, not great. This is a weak example of a setup, right? So one thing that you want to get really good at is not trying to make too much sense of this kind of stuff. If you do have to make sense of it, here's what I would do. I would go to a 4-hour chart and look at that. Okay, well, 4 hours still looks gray to me. Okay, well, let's find a trend. Can we find a trend anywhere? The hourly, this doesn't look like a trend to me. So what I would say is I would just remind you, most of the times things are just messy. Here's also what I can do for you. So why don't we look for something that actually looks decent, and then I'll just reverse engineer it. So like PL, right? Now I'm not saying PL works, because if the market gets creamed, this is a very high beta, messy stock. But you see how when I pull up Microsoft and it has gray bars and I'm having to look inside of it and I'm twisting my head, right? We're doing this dance, right? The whole point of the class, guys, is so that you don't do that. There's a million things in the world. We do not have to stare at Microsoft gray and try to make sense of it. And then there's this even worse belief. Well, Sam, I did what you told me to. Microsoft was gray, so I went and found something else. and then Microsoft is up $20. Okay, that's it doesn't matter is the answer, because that's like poker, right? If you get a jack and a three in poker, it's a terrible hand. You fold it unless you're planning on playing like a maniac and bluffing. But in most cases, jack three in poker is a fold. So then you fold jack three, as you should, and then the flop comes jack three three, and you think, oh, I should have bet that. I knew it. No, you shouldn't have. That is the most amateurish way of thinking, right? I should have held my hand because it hit. So 2 points. One, with Microsoft, it's gray, and I don't necessarily see a clean setup either way that doesn't require some leap. It's not a short, I can certainly say that. And if you were looking to trade it, just trade it on smaller time frames that are exhibiting trending behavior. This is an example of something that is much cleaner. Now, I'm not saying this works because the market does need to work for this to work, but it is clearly, something that has a squeeze. That's why it popped up on the list. It's got a squeeze, and it has a very high score. So just a reminder, most of the things that you're going to look at are noise. If it doesn't make sense to you, and the indicator will make sure that it makes sense to you, all you have to do is use your eyes. If the indicator is not popping to you, find something else. Hey, thank you, Myron. Thank you for being here. Yeah, the high low is always going to reflect the time frame that you're currently in. So high low, if you're on an hourly, it's hourly. There's no higher there's no issue with that. When a buy signal prints, how many new bars going forward is it still valid to enter the trade? As long as the buy signal prints and you can control your risk, the trade is valid. You can get a situation where it doesn't pull back to the 10, but the candles will still be green. Absolutely. So that's happening a lot, just because there's no pullbacks anymore. But if you look at something like SMH, like, actually, let's go even crazier. Let's go Intel, yeah, without a single pullback. So this is a good example. So here on Intel, and again, for the folks that are like, oh, the bubble this, the bubble that, look at the moves you're catching, folks. Like, and this is a clean one, right? This the only ones that I would even maybe let's maybe dissect this one. I don't want to get too in the weeds on this, but let me just dissect this one for a second. Okay, I see it. So this one gave a sell here. The sell, the sell here, it actually would have triggered here, but and then you get the buy, and the buy is clean. I mean, green and red rarely have issues. It's just the white that, and it's situational either way. So here's an example of what he's talking about. So you get a green buy here on Intel at 50, and it's green bars, green candles the whole time, but it doesn't trigger another rebuy at all. Why is that? You should be able to answer this. Hopefully. Starting to question my my communication skills a little bit here. Yeah, so this one triggered a buy here because it changed from gray to green so fast in that little period of time that it triggered the buy. Okay, so notice how here, when it reconnects with the 10, it's light green. Light green does not trigger buys at the 10. Here, it's dark green, but it's so hot that it's so far above the 10 that it's not triggering buys either. So the way that I would read this is, and this isn't just Intel, this is anything. The last signal is the current signal. And then from there, if you want to chase it and do whatever you want, that's between you and your trading plan. But always remember that the last signal is the current signal. And you know, if it doesn't ever pull back, then it can't ever actually trigger a buy against the level that it's designed to trigger a buy. No, the buy and sells appear in that moment. They don't wait till the very end. They appear in that moment. Yeah, I think we yeah. If we're playing the daily time frame, we will get the signal to enter during the day, or is it tomorrow? It always will happen on that day that it's printing. The signals aren't. Man, this is so tough. Like you really have to just you really have to kind of like just you have to see it in action. There's no like cleaner way I can say it. I wish I could show you like a better example, but you guys don't seem like it doesn't. I don't know if it's not clicking or what. So let's say let me just think of an example. I'll just use this example. So here it goes from gray to green, and it does so rapidly that it triggers the buy here. Okay, that would be present at whenever that day is occurring. So if I looked 2 hours before the close and the signal was true, it would say buy. If I looked in the morning and the signal was true, it would say buy. If I looked in the afternoon and the signal was true, it would say buy. If I looked at the close and the signal was true, it would say buy. Okay, so that's that. One last time, so we're all on the same page, and really try to go back and rewatch this at some point if this is not immediately clicking with you. I understand there's nuance to this, but it was explained, and it's not all that complicated, I think. This is the example. Okay, so one, as you guys grade yourself in terms of how well you've understood the material, see if you can grade a chart, see if you can look for things on a chart that would cause it to change. The primary one is going to be the true momentum. When you have compression of the lines here, then that nukes the score, right? You go from getting points because the lines are correct to when they're no longer correct, all those points go away, right? And so what happens? The bars turn gray because you've lost a ton of points right away. What I'm trying to say is that if you looked at this chart in real time, this bar would have been green on Monday. That's a Monday bar. This is a Friday bar. Okay? We're on the same page there. Monday, Friday bar. This is 1 week of trade. That's a Monday bar. That's a Friday bar. If you looked on Monday, that bar would be green on the close. If you looked on Tuesday, this is probably, now that I'm looking at it a little bit more closely, the gap down is likely what triggered this. So on Tuesday, the second bar, this bar, so let me just draw it out. This bar on Monday close would be green. Okay? Monday close, this bar still green. The gap down, close lower, likely triggered the compression here. So what happens? This bar correctly becomes gray in the moment, completely as you would expect. However, because it's a 5-day look back on daily only, then this bar would retroactively color gray because of the compression from the drop and then trigger the sell. This is one of those things you just have to work with. If this did not click the way that I just explained it, there's no better way that I can explain it. And you just have to work with it. And for the pushback, for the folks that are like, well, it didn't catch the absolute high. Who cares? Who cares? There's no professional trader that I've ever met who's trying to catch absolute highs and absolute lows. That's amateur hour. So the goal is not that. The goal, and let me kind of go back to this one. So Intel, a buy at 50, it runs all the way to 133. It's so hot that even though it has a sell signal here, you see how the lines are compressing? It still hasn't triggered a sell. Let's say it triggers a sell, and this is not even a great example, but let's say it triggers a sell on Monday at 100. Okay, well, all you had to do was buy there, and then you got dumped out at 100. You made a double, right? And there's countless examples of this. Like, there's literally countless examples of this. So what I would say, guys, is just specifically for the white reversal stuff, that's as clear as I can make it. The example I just gave you on SanDisk. Every question that I'm going to answer from now until the next 20 minutes when class is over is going to be a different question, if you guys have any more. But if that didn't make sense, I think maybe just follow up with me on email, or really the best way to do it, go out there, swing the golf clubs. Use the indicator. Use it. It works. I know it works. In simplest terms, green candles and green momentum equals buy. Red candles and red momentum equals sell. Gray candles means use. Yeah, I mean it's amazing when you can say it that simply, huh? Yeah, no, you're correct. All of that is correct. Let me reread it just because it does summarize everything we've covered so far in a very nice way. Green candles and green true momentum equals buy. Red candles and red true momentum equals sell. Gray candles means use high low. You got it. Okay, so this is going to be the very last thing that I cover on this because I think I think probably at this point I have to believe that I'm speaking to the minority of people on this subject. Not every buy and sell bubble is delayed. It 100% has to do with the positioning of the true momentum lines. If you have a large spread between the lines, they will never reprint. The reprinting is subject to happen on white bars when the lines are very, very close together. I mean, I don't want to raise my tone here, but it's like, I don't know how much else to describe this. So let me reset my chart here. This is not a thing that happens all the time. This is a outlier event. It's very important because this is going to affect your confidence if you don't understand what I'm saying. It's an outlier event. This is not a feature. It's an outlier. The way that you understand it is, are the lines super close together? If they are super close together, then on any given day of this 5-bar window, they can reprint. If they have a spread between them, like we looked over here on SPY, that will never, ever, ever be an issue, right? There's a too big of a spread here. So here's the way I would summarize it, and then I do have to move on from that particular topic. This is subject to reprinting. This never subject to reprinting. That's it. If you are concerned about it, use a smaller time frame, and you can always look inside of the tightness and see what it looks like, and then go off that signal. So let's say that we were here, right? So let's put ourselves in two different places. This is one moment in time. This is one moment in time. For this moment in time, there's nothing to do. Super easy. We just follow the colors. No issues whatsoever. We don't expect any issues. No reprinting. Every bar will print on that day. Trust the signal. Go with it exactly as you expect. Happy-go-lucky. Great. Here, it requires more depth. Correct? So here it requires more depth because there's a tightness here, right? And on any given bar, given that the look back is five days, it can change, right? So the only time that it'll ever reprint is when it looks like that. If it ever looks like this, it will not reprint. But to move on, the it's an 80-20 thing. It's most of the time it will not be an issue. The reason I brought it up and I wanted to spend some time on it is so that you're hyper aware of it, so that you can just use a smaller time frame. So here's what I would do, and then I do have to move on finally. That here, I change nothing. I just go off the colors, the bubbles, the labels, everything I just showed you. Here, I would probably suggest using an hourly chart. Because ask yourself, what is the indicator really telling you when the lines are that close? It's not really telling you much. So use an hourly time frame, and then you can navigate that way. Thank you. Yeah, so you could say it this way too. If it's not a clear setup, just wait for the next opportunity. Yeah, that's actually a running theme that I was trying to keep going here. Okay, guys, I think I got to start winding things down a little bit. I'm not really seeing any super critical things that are not in the presentation. Most of what I'm seeing is actually has been answered and is in the slides. I'll make sure that these slides are posted as well when the video is uploaded. So you're going to have the slides, you'll have the video, and then you can certainly feel free to review that. After you review it, just let me know what doesn't make sense via email. So I do want to say this, and we'll see if I regret this one. You guys have me as a resource, right? So let's actually start winding down. Yeah, let's wind down because I'm not seeing a whole lot that's additionally super valuable, and I think we've kind of covered everything as much as I possibly am capable of today. So one, let me start by saying this: it should all be in the slides and in the class at this point, the class recording. So most of the answers that you're looking for will be found in there. Let me also say this. I am certainly here as a resource for you. If you have any questions, any charts that you want to review, trades that you want to review, I'm available to you via email. Now, give me some time because, it might be busy, but use me as a resource is really what I'm trying to say, right? If somebody offers themselves as a resource and they're the ones that made the indicator that you're using, it's probably a good idea to use them as a resource, right? So I'm not, I'm highly encouraging you to use me as a resource. So I'll say it that way. So any questions that weren't answered, send me an email. If you have a chart that you have questions about, send me an email. I'm open to speaking to you about anything other than scans or tech support. So if you have any questions regarding those two topics specifically, do contact support. They will be able to help you out with that. But let me just reiterate that I would be happy to be a resource for you guys. I get that it's a new indicator. It is very, in my opinion, very intuitive. Some of you guys have exhibited that tremendously in some of your trades that you've done. We've seen the feedback. But like any new thing, and just like anything in life, it's nice to have somebody to chat with. Let's just call it what it is. So if you do have any questions on this, shoot me an email, sam@simplertrading.com. I'm going to scroll just a little bit more, and if I don't see anything else, then I'm going to kiss you on the cheek and send you on your way. And stick around. Don't let me kiss you on the cheek. If you stuck around this long, stick around to the end. What's another 5 minutes? You used the indicator last week. You made insane profits on NDX options. You were able to hold longer. Thank you. Okay. Yeah, it looks like most things are either answered by the mods or the rest of them. All right, guys. Well, let me go ahead and start signing out here. So again, thank you so much, guys, for being part of this class. Let me kind of go back to really what matters here, right? Let's get back to what really matters here, and it's one of these, right? So I am absolutely, for lack of a better term, blessed to be here with you guys. It's all so improbable. All of this is just massively improbable. The fact that I once worked at Apple and I had that as my screensaver, and now by just pure chance, I work for a guy who has one of like the only lithographs of that painting or that print that exists. It's nuts, right? When you think about all of the probabilities that it would take to achieve that. You guys, I spend more time with you guys, those of you that are in the MTT room, than I do with my own friends or family. Even for those of you that are not in the MTT room, I spent more time with you today than I'm going to spend with my friends or family this entire week. So I am very grateful for that. Without John having made the Library of Alexandria for me to study for 9 years, none of this would be possible. I am very aware of the fact that I have the goods with this indicator, and it makes me pretty excited, the fact that it's out there now, because I get the chance to get feedback from other people on it, and the feedback has been amazing. So thank you so much for being here. This was intended to be the Thriller album, and I think in this case, the last class, maybe I was the star of the show, and the indicator was, in terms of the Thriller album, the indicator was the backup. Today, the indicator is without question the star of the show, and it was an absolute pleasure to spend my Saturday with you, and I hope you have a good rest of your weekend. Cheers.